We're back to tariffs on.
Of all the countries who are lining up for a deal with the United States, the European Union is going to have the hardest time.
We're also waiting for just more clarity around what the tariff policies will eventually look like.
We've seen our commentary change not just week to week, but day to day.
Tariffs, we are still waiting to see the actual effects of tariffs, both on earnings and on the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into a new trading week as the president backs down.
We spoke to European Commission President von der Leyen. We had a very nice call, and I agreed to move it. I believe July 9th would be the date. That was the date she requested. She said we will rapidly get together and see if we can work something out.
Equity markets bouncing back as President Trump extends the EU's tariff deadline. The Fed firmly on the sidelines as one official accepts trade talks could take years to resolve, and bonds finding some support as Japan signals it may be prepared to tweak debt issuance. That move fueling a bond market rally worldwide.
And perhaps just emboldening people who are bullish on equities around the world, because that has been one of the big questions. At what point, given some of the exhaustion around some of the trade bingo about where we are with respect to the trade talks, where is the bond market in terms of fiscal concerns, in terms of just demand, and the fact that Japanese foreign ministers, finance ministers are going to come out and say, look, we're not going to sell as many ultra-long bonds right before a 40-year debt issuance has calmed a lot of people who've been very concerned about the amount of supply on the horizon.
40-year debt issuance from Japan tomorrow. Heavy slate of U.S. supply this week as well, at a time when people are concerned about fiscal deficits, not just stateside, but worldwide. Secretary Bessent on Friday, speaking to Bloomberg, pointed out the global aspect to all of this.
Just basically trying to underscore the fact this isn't just one big, beautiful bill. What did Annmarie call it?
One triple B.
One triple B. Thank you. I need to get that. One triple B. Other people say 1B3. It sounds like it's sort of provision to the actual fiscal provisions. I'm just wondering at what point this is deficit concerns, at what point is this global debt issuance, and at what point is this just simply a narrative run amok with hedge funds that are getting stopped out of basis trades and people trying to figure out exactly what narrative to put around it. There is a 7-year auction on Thursday, which is the one that I'm watching most closely. $44 billion. It's a 2-year note auction today, 5-year note tomorrow. The longer the duration, the more interesting it gets, as there's really a question about who the ultimate buyer is going to be.
So that's the debt. We need to talk about tariffs as well. Going into the long weekend, it was meant to be quiet. It wasn't quiet. The president threatened an additional 50% tariff on the EU. Backed down from that over the weekend. Also threatened Apple with a 25% tariff. Clarified that would apply to all smartphone makers making those smartphones abroad. So Tim Cook is still in the penalty box, isn't he?
Well, yes, it's an issue with iPhones. Of course, someone got into President Trump's ear and said, hey, does that give Samsung a huge advantage because everyone's just as good to get an Android since suddenly iPhones are going to be a lot more expensive? Look, the bottom line is this. First of all, we still don't know what the ultimate goal is. Why is the trade discussion more difficult between the EU and the U.S. than the U.S. and China? And then when it comes to specific tariffs on companies, how much is that actually going to incentivize them to produce in the United States? Morgan Stanley came out over the weekend and said even a 25% tariff on iPhones that are not made in the U.S. will not incentivize Apple to move production to the U.S. because it still will be more expensive and take longer to get it back here.
Equities bouncing back this morning at least. We're higher by 1.7% on the NASDAQ, on the S&P by 1.5%. Coming up this hour, we'll catch up with Steve Chiavarone of Federated as President Trump extends the EU tariff deadline. Tom Forte of Maxim Group on Trump versus Apple, and Robert Sockin of Citi seeing slowing global growth. We begin this hour with stocks higher as President Trump extends the EU's tariff deadline. Steve Chiavarone of Federated Hermes sounding positive, writing this. We expect U.S. equities to outperform global markets in the second half of the year. The worst is behind us. Steve joins us now for more. Steve, good morning. Good to see you. Good morning. You stayed very calm, level-headed over the last couple of months. Just remind us all, your strategic anchor, looking out 12 months, what is it at the moment?
It is companies that had every excuse to let workers go or to kind of slash their guidance. And in some cases, they pulled it, but they just suspended it. They didn't cut it. So you've got earnings growth that still looks pretty decent. You've got pro-growth tax policy coming. You've got deregulation. And you've hit the peak of tariff uncertainty. That doesn't mean that there won't be tariff uncertainty. I wasn't shocked by what the president did with the EU, right? He was, you're about halfway through that window. He wants to make sure that deals are coming across the finish line. He doesn't want folks stalling on him. So he was going to take someone out to the woodshed and remind them that, the de-escalation can go both ways. But with that being the worst of what's behind us on the tariffs, tax cuts being the discussion, deregulation being the discussion, and a labor market that has remained remarkably solid, it's hard to get overly bearish in front of that.
A lot of people are spooked, though. Spooked by the return of uncomfortable correlations, the correlations that have broken down between the equity market and the bond market. Those two asset classes still moving in lockstep. Mm-hmm. Does that concern you?
So I've been spending most of the last 2 weeks trying to understand what's going on in the bond market in particular. And, sometimes we put an easy narrative around something that's a little bit more complicated. If what was going on was just the bond vigilantes stepping in on the big, beautiful bill, then that doesn't explain what's going on with German yields. It doesn't explain what's going on with Japanese yields, which have also kind of surged. So either there's a global phenomenon or the U.S., Germany, and Japan are all facing their own issues related to the bond market. And I think once investors look at that, the U.S. will still be the best house on that street relative to Germany that's spending to buy bullets and Japan that's in kind of fiscal disarray.
Just to build, though, on what John's talking about, the one consistent theme, barring today, has been a weaker dollar. And this has come in tandem with higher yields in the United States. So even though this is a global bond market story, there is a specific U.S. aversion that is baked into that. And why does that not scare you, that we can't necessarily look at the old rules as applying in a new world?
I think you need to take a breath and wait on that. I don't think we know for certain yet. And the reason why is we still have the debt ceiling. Right, the debt ceiling's hit. We're in extraordinary measures, which means that Treasury is spending down the general account. So they're pumping dollars into the system that once you have a big, beautiful bill will have to be repaid and debt will be issued. So I think what you may see as we get this bill across the finish line is that the dollar may strengthen, but bonds might weaken a little bit. And so I think that there are some kind of technical oddities around how we're financing ourselves right now that might be distorting things with the dollar. Because it really doesn't make sense if you think about it. If you've got growth that's a little bit better in the U.S., you have a Federal Reserve that's a little bit less dovish, tariff policy that's in place, that doesn't generally argue for a weaker dollar. So I think you've got some specifics around that debt ceiling that might be muddying the waters. I think we need to see where we are in a couple of months on the dollar, and then we'll know if that's a trend or if that's just a technicality. Sometimes you just have to wait and see.
So how do you block out the noise? And I say this at a time when I read things like there's certain fear fatigue. People are exhausted of holding U.S. assets and being swung from day to day on the tariff negotiations. There's a discussion around foreign investors that have talked to a lot of fund managers who've come to this table, particularly in Europe and Canada, saying, we just can't really deal with this anymore. How do you dismiss that as being anecdotal and not necessarily wholesale in some sort of longer lasting trend?
Well, you don't dismiss, but you have to choose which sins you're willing to commit, right? If you think about it, the whole reason our industry exists is because people don't have enough money. They need it to grow. They need it to compound in the market. We can be forgiven if we keep people invested a little bit heavier going into a period of volatility, right? That's part of the game because over time the market moves higher and you can invest through that, particularly if you have some cash on the sidelines that you can deploy. What you can't do and where you really get yourself into trouble is when you panic, move money out of the market and then you can't get it back in, right? There's this sense that not losing a dollar is somehow more noble than not making a dollar. But the probabilities are completely the opposite. We get paid to take that risk. So it's not about whether or not you take your ball and go home. It's just trying to understand which parts of the market may be a little bit more advantaged. There's always an opportunity to generate alpha. You just have to remain calm. And this idea of fear fatigue, well, we get paid a fee to not get tired. That's what our industry exists for. So you try to create a framework, you understand the probabilities, and look, if you overreacted to Trump 8 years ago, I can understand that. Today, we know the game. We understand how he does this. He's not unreasonable. Now, he may take a very, very strong and almost absurd starting position to shock the world in a negotiation, but he always generally comes back into something that markets can deal with. Now, whether you think that's the right thing to do or not, that's a personal problem. From a money management perspective, you remain calm and you invest for the end point.
Have you increased your equity exposure in the last month or so? And if so, where have you done that?
Yeah, we did. So we put up a picture of Ulysses sailing through the straits strapped to the mast at the beginning of the year. And our goal was to not get caught up in the volatility and add to the equity weight. And the opportunity that was the most compelling for us in the sell-off was in large cap growth. I mean, you saw, you had the Mag 7 trading at 2, 3, 4-year PE lows. They were 6 multiple points below their 3-year average, down 20%. Look, these are companies that navigated an almost collapse of the financial system in 2009 and us turning off the entire global economy with a light switch 5 years ago. I think they can handle a sales tax.
Have you been buying 30-year treasuries?
No, we've been more neutral in duration, although I will say that, honestly, because what we found is where you'd want to take risk in the bond market if you're going out in terms of credit, the spreads are so tight, we'd rather take the equity risk. And so, I'd much rather buy or had at the beginning of the year, solid dividend-paying equities than buying high-yield treasuries at 300 basis point spreads. So it's really we've been underweight bonds at the expense of equities through the year by about 4 to 5%. I do think that the negativity around the bond market is starting to get to a place where you got to take the other side of it. I really do. I think whether it is the big, beautiful bill not being quite as deficit enhancing as people anticipated, and I think when you take into account tariff revenue, it's not quite the deficit monster people think. I think when you see central banks and foreign governments starting to step in bond markets, deregulation, you've heard Bessent talk about maybe suspending the SLR. I think we're getting to a point where you're going to want to take the other side of the bond market and be contrarian. We haven't pulled the trigger on that yet.
Steve, when you do, drop by.
Will do.
It's good to see you. As always, Steve Chiavarone there at Federated Hermes. This morning, the bond market rallying, yields lower on a 10-year by 5 basis points. Your yield, 4.46. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Anand. Hey, Yahara.
Good morning, John. The European Union has agreed to speed up trade talks with the U.S., this coming just days after President Trump criticized the group for slow-playing negotiations and taking advantage of the U.S. A European Commission spokeswoman says there is new impetus for talks after Trump extended the deadline for 50% tariffs on the EU. Meanwhile, President Trump is growing more frustrated with Russian President Vladimir Putin. The president spoke on Sunday saying he's absolutely considering sanctions. It came before Russia launched its largest drone barrage yet against Ukraine. The Kremlin is dismissing the president's comments as an emotional reaction. And HSBC dismissed more than 24 analysts, and those affected include Stephen Major, a frequent guest on our network. That's according to sources telling us here at Bloomberg it's part of a sweeping restructuring of its investment banking business. The restructuring, led by CEO George El-Hedary, is expected to lead to $1.8 billion in charges over the next 2 years. That's your Bloomberg Brief. John?
Yahara, thank you. Steve Major, absolute legend, and any bank would be very lucky to employ him. Up next on the programme, the EU comes to the table.
You spoke to European Commission President von der Leyen. Did you discuss the 50% tariff? She just called me, as you know, and she asked for an extension on the June 1st date. And she said she wants to get down to serious negotiation.
Up next on the programme, Terry Haines of Pangaea Policy, live from New York City this morning. Good morning. Getting back to work after the long weekend, and equity futures are bouncing back by 1.5% on the S&P 500. On the NASDAQ, up by 1.7%. One single name of the pre-market, Apple. Apple lower for 8 consecutive days, the longest streak going back to 2022. And over that period, down by more than 8%. This morning, the bounce back looks like this. We're up by 1.9%. This is one to watch with additional tariffs in focus. I want to turn to the bond market as well. 2-year, 10-year and 30-year. Some support coming into fixed income. Treasury yields are lower. We're down by 5 basis points on 10s, down by 7 on 30s. Lisa, just on the sidelines, the conversation around Japan and the Ministry of Finance maybe stepping in and tweaking bond issuance.
Maybe reducing some of their very long bond issuance at a time where you've seen the sell-off really permeate through that region. So is the Japanese bond market now dictating where the U.S. bond market is going? This is something thing that we just heard Steve Chiavarone speak about. It is a more complicated story than just the one big, beautiful bill in the U.S. This is a global story, and it's something that people still are trying to figure out.
A better tone in both bonds and stocks, at least so far this morning. Under surveillance this morning, the EU comes to the table.
You spoke to European Commission President von der Leyen. Did you discuss the 50% tariff?
She just called me, as you know, and she asked for an extension on the June 1st date. And she said she wants to get down to serious negotiation. We had a very nice call, and I agreed to move it. I agreed to do that, and that she said we will rapidly get together and see if we can work something out.
So here's the latest this morning. President Trump extending the EU's tariff deadline to July 9th. Sources telling us here at Bloomberg the European Commission is coming to the table, focusing on critical sectors including autos, chips and more. Joining us now, the team coverage with Bloomberg's Tyler Kendall in Washington and Ollie Crook in Berlin. Ollie, walk us through the ask. Do we understand the ask from the US of the Europeans?
I think not yet, and I think that's the frustration from the European side. And of course, the frustration from the U.S. side is that there's nothing concrete enough for them to really sink their teeth in at this point, and that we're still deep into the weeds. The message from the European Commission over the last couple of days has been, listen, we're now on the fast track with negotiations with the United States, trying to breathe some momentum and a bit of positivity into these talks that really, frankly, has not been there so far. So what we understand now in terms of the focus of the EU Commission is they're going to focus on negotiating first the big five. That is going to be steel and aluminum, cars, pharmaceuticals, semiconductors, and planes. There is still the issue of the non-tariff barriers, right? This is part of the complexity of negotiating on behalf of 27 member states. Some of the issues the Trump administration wants to deal with are under domestic regulatory or tax sort of considerations, and the EU does not have authority to negotiate on. And they want to also fold in some of the regulatory barriers with a broader simplification push that the EU has been pushing for the last couple of months in their new commission. But when I hear that, John, I get a little bit worried because we only got about 6 weeks worth of runway here. And I know how much time it takes to get some of these initiatives through the EU and how difficult they are to understand. And that is not what the Trump administration is after.
Tyler, July 9th, how difficult is it going to be to get something over the line?
Well, we also have to keep in mind that that's the same date that these other countries are also up against when it comes to negotiating the so-called reciprocal tariffs. And while, of course, this is a positive step to allow some more runway, there's still a long way to go here, as you were hearing Oliver outline. At this point, there really has been frustration from the European Union that it's unclear what the U.S. needs to see in order for there to be a deal. But on the other side of it, we've really heard White House officials repeatedly tell us that their point of frustration is that it's been hard to build consensus since they are negotiating as a bloc, and it's hard to get all 27 member states to ultimately agree. We're going to be watching really closely, of course, some areas here. Of course, those critical sectors that have been subject to Section 232 investigations, but also how the EU perhaps pledges to boost imports from these areas. Also, U.S. LNG is an important one to watch. But ultimately, John, we're going to have to see how this shakes out because there's a lot of difficulty here when we know that the White House is prioritizing those non-tariff barriers, which at this point, a lot of it seems to be a red line.
Tyler, Ollie, to the both of you, thank you from Washington, D.C. and from Berlin, respectively. To extend the conversation, Terry Haines of Pangaea Policy. Terry, welcome back to the programme, sir. Why have the Europeans found themselves in such a difficult spot?
There's a couple of reasons, John. One is just the nature of their federation. Those of you who are American history buffs consider the EU much closer to the Articles of Confederation, where, as one of your correspondents said, every major decision has to go back and be played through each of the 27 member countries. So, the structure's not great. There's also tensions between the European Commission, kind of the Supremos in the Berlaymont in Brussels, and the 27 member nations. So that makes for a very complicated group. And just about every other negotiation that the United States is pursuing, whether it be with the UK, whether it be with India, whether it be with Japan, let's say, or even China, you know who you're dealing with and you know what kind of response you're going to get. So this is uniquely difficult.
Terry, do we have a better understanding after this weekend of what the ultimate goals are with these negotiations, what the desired outcome looks like?
On the EU, I don't think we do, but my view of this is that, Rudnick and his people at Commerce had gone out before the April 2nd date and had given various countries wish lists of things that they wanted. So whether or not somebody in the Berlaymont got a list, I think is beside the point, because a lot of the member countries did, almost certainly. Germany did, France did. I mean, there's the main countries in the European Union know what the United States ask is generally, but the EU as a whole has to get down to it. And the scheme of the EC is always to delay, as any British prime minister in the last 10 years well knows.
Do we get a sense that the one big beautiful bill and the fact that it did pass in Congress gave ammunition to the administration to focus back on trade, and that we can expect a lot more headlines to be made about trade over the next few weeks?
Well, I think they've been doing both, but I think there's probably a lot more headlines on trade to be had simply because, the Senate negotiations on the tax bill are kind of, much more in the can. They're much more baked. Everybody knows what they are. But the expectation is that over the next month, you're going to see a lot of those major deals. And, one of those is India, where the Indians have said quite publicly that they expect a deal to be done in the first phase by July 9th, with 18 more sectors by October. Whether or not the United States agrees with all those, that framework or not is another thing. I doubt that they hugely disagree with it, but there's a lot of optimism coming from India. And, I've always thought that's exactly how you have to read what's going on with Apple, is through the Indian trade negotiations, not as anything that's been going on with Apple.
Terry, just build on that. What do you mean by that?
What I mean is that people tend to look at, look, I'm not an Apple analyst, okay? I'm not saying buy or sell Apple. What I am saying is that the markets tend to look at Apple or, Tesla or, whatever, in a very siloed sort of way. What's going on? Trump's mad at them. Trump loves them, whatever it is. What's going on here, almost certainly, I think, and this is instinct, but there's U.S.-India negotiations way down the track. India is a major beneficiary of offshoring from China, in this case, iPhones to India. Trump likes to shake up negotiations. It's a standard negotiating tactic, not just for him. And the part of the shakeup is, well, I'll introduce something new into the mix. Let me remind you, India, that you're the beneficiaries of United States policies here. So I'm going to put that one on the table too, and then we'll figure out where our negotiations go from there. So, I'm just looking at Apple as a bargaining chip in the larger trade negotiations with India, frankly.
Terry, there's also a foreign policy wrinkle in the mix as well, the threat of secondary sanctions against Russia and what that could mean for India, for China. How's that going to play out in the next few weeks and months?
I think it matters. It matters in the U.S.-EU negotiations too, John. It matters greatly because what you're going to have is a situation where, this is a classic watch what they do, watch not what they say. The European Union heaped a lot of scorn on the Trump administration and Trump personally, and Vice President Vance personally, for their remarks over the winter and their going in position on Ukraine. But now we're in a situation where the geopolitics are different, and the United States, as well as the European Union, are taking the shackles off the use of weapons that are provided to Ukraine by all of those countries. What you're going to see in the successive weeks, I think, is a geopolitical ramp up that's designed not just to put more pressure on Russia, but more importantly, put more geopolitical pressure on China to get their client state Russia to the table. So this is yet another example where the geopolitics is driving the economic policy.
Terry, it's good to hear from you. As always, smart. Terry Haines there of Pangaea Policy. A geopolitical dimension to the trade talks make this even more complex than it already is.
Especially as we heard President Trump talk about the possibility of secondary sanctions over the weekend in response to some of the attacks, additional attacks on Ukraine. If everything's a pawn, there's this question of what the ultimate game is, and I think that's what everyone's trying to get their head around.
Equity futures doing better this morning. If you are just joining us, welcome to the programme, higher by 1.5%. Up next, we'll catch up with Tom Forte of Maxim Group on President Trump versus Apple. 4-day slide on the S&P 500, looking to erase that this morning. Equity futures positive by 1.6% on the S&P, up by close to 1.8% on the Nasdaq 100. That's the index level price action. Let's get you some single names. 3 hours away from the opening bell with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. DJT, Donald Trump's media group, on the upside this morning, up nearly 10% in the pre-market. There's some FT reporting yesterday that they're looking to raise $3 billion in order to buy cryptocurrencies. This all ahead of a big conference in Las Vegas where Don Jr., Eric Trump, and David Sachs, the White House crypto czar, will all be speaking at it. So the thought is, if you're going to make an announcement to this caliber, why not do it in Vegas for that conference? So those shares moving higher. We also have a little bit of deal news, some exclusive reporting from the deal team over at Bloomberg. It looks like Salesforce might be buying Informatica. At least it is examining this again. This is a revival of an old deal. They had looked at doing it last year, the software company. Those talks fell through. Well, they're giving it another look. Informatica up 8.5%, more than that. It's a huge rally because we also learned this on Friday where shares gained 17%. So we're really adding some weight to that. Finally, wrapping things up with Stellantis, also moving to the upside, just showing the extent to which a lot of stocks this morning are moving on that trade tariff 50% on the EU pause that we got over the weekend. Stellantis up 7.4% for its U.S. ADR, even despite the fact we got some European auto sales. They looked pretty weak. Stellantis fell about 0.5% year over year. But even so, that story injecting some optimism into shares this morning, John.
Danny, thank you. Danny Berger there on some of the movers out there for you. More from Danny in the next hour. On our radar this morning, our top story, the EU fast-tracking trade talks with the US just 6 weeks before President Trump's 50% tariffs would go into effect. The European Commission focusing on critical sectors including autos, semiconductors and pharma.
The response, I think, is really important, and Danny just highlighted it, that the bounce back has been much more significant than the sell-off was on Friday to the announcement of a potential 50% tariff on all European goods, which just highlights that people kind of have understood the game. To quote Steve Chiavarone, they don't take it that seriously, the idea of a 50% tariff on the European Union, because that would, by all economists' accounts over the weekend, would have sent the region into recession. But the declines were some 1% on the DAX, 1.7% on the stocks 50. So you start looking at these kind of declines and then you start looking at the rebounds this morning. I think that you get a sense of where people's minds are.
We've got these two self-imposed deadlines now, July 4th for the tax bill, July 9th for the conversations around tariffs. What are we going to look like July 10th? By the time we get to the start of July, after that first week, second week, what does the world look like? What does the policy mix look like? And Steve Chiavarone making the point that after we get over this hump, by the time you get to the end of the year, the policy mix will still be favourable, and that's why he's long equities.
I just think that the hump gets moved. I don't understand how we get some sort of comprehensive trade deal by July 9th from all accounts, given the fact that you're talking about a lot of non-tariff barriers, whether it's the VAT tax, whether it's some of the regulatory overhang in Europe. Imagine changing all of the regulatory frameworks in Europe over the next 45 days. Does that seem feasible to anybody? So there's this real question mark of what it will take to push that hump later in the year so we can really be talking about that.
And the Chinese issues are going to linger. Take a listen to this. The Chinese President Xi Jinping is working on a new version of his Made in China 2025 campaign. Sources telling us here at Bloomberg that China will stick with plans to prioritise chip production despite criticism from both the US and from Europe too.
And this comes in tandem with a lack of initiatives when it comes to trying to really boost domestic consumption. So this raises a question. Will China commit to having its residents spend more money, or is it going to double down on what it always has doubled down, which is manufacturing? And what you have seen is that even though exports from China into the U.S. have gone down a lot since some of these trade issues really percolated to the surface, you've seen overall exports from China to the rest of the world surge to new record highs. So this really raises this question of, are they going to just try to find new lands to sell their goods to and get them even cheaper, as you see things like places like BYD cut prices to new lows to try to get that market share?
Or just sell even more to the Europeans, which goes back to Europe. And I think this is the important question. What is the ask of the EU? Is it to drop tariffs on the US or raise tariffs on China? Are they going to be part of the negotiations, that dimension of this story, part of the negotiations in the weeks to come?
This is going to be the ultimate question. When we first set out with this agenda, we thought, OK, this is to try to bring some sort of coalition together to counter China and the threat of overproduction and sort of exporting cheap goods. it's hard to see how they're making strides toward that. Maybe that is part of the goal, but I think a lot of people are wondering how much that's part of the conversation right now between the U.S. and the EU.
So we've taken down the temperature on trade just a little bit after we turned it up on Friday, going into the weekend, and equities rally. Bond markets are rallying too. Japanese bonds rallying hard on signs the finance ministry may be prepared to adjust debt issuance following a market rout. The move pushing Japanese bond yields down and weakening the yen. We're seeing an aggressive rally at the long end of the curve, not just in Japan, but elsewhere too.
Yeah, and this really highlights the question as Scott Besson addressed, which is this is a global move. How much of this really stems from the United States and the loss of exceptionalism and concerns about the deficit, and how much has to do globally with an increase in fiscal spending and some sort of other shift, given the fact that you see inflation. You also had the Bank of Japan talk about possibly raising rates more quickly. So this raises this issue at a broader level. If this isn't just a U.S. phenomenon, what is this in the bond market? Is this a more persistent, sustained level of rates that's going to be higher? Is this a narrative looking for a home and finding it in the bond market? Or is this something that is a distortion that a lot of people will look to buy?
Japan is a big piece of the bond market puzzle, particularly this year. It always is. Yields are lower across the curve. Stateside on a 10-year this morning, we're down 4 basis points to about 4.47. Let's turn back to trade. President Trump threatening Apple with 25% tariffs unless it manufactures iPhones in the U.S. Tom Forte of Maxim Group writing, in the event that leads to iPhones made in the U.S., we believe Apple would have to implement heavy automation to make the cost more competitive. Tom joins us now for more. Tom, welcome back to the program, sir. Before we get into the operational issues, I just want to talk about the reputational problems. Tom, why do we see this issue with Apple in a way that we didn't in the first term? Is the president's problem with India, with Apple, or with Tim Cook?
Yeah, so I think clearly the administration is trying to accomplish 3 goals: reduce the trade deficit, reduce the budget deficit, bring some jobs back to the U.S. So I think that's really the focus of the second Trump term. Apple's caught in the middle. They're caught in the middle between the U.S. and China. They're caught in the middle between the U.S. and India. Their global supply chain right now is putting them in a tough situation.
At this point, Tom, does it seem likely that they're going to raise prices regardless, just to insulate themselves from that uncertainty?
Yeah, so when you look at the situation with tariffs, we're trying to determine 3 things. To what extent can a company lean on its suppliers to absorb the cost? To what extent does the company need to absorb the incremental cost? For Apple, they pointed out that $900 million figure for the June quarter. And then to what extent can the company raise prices? The good news is that we believe that Apple can raise prices to offset this tariff increase. Historically, Apple's strength is at the high end of the consumer electronics market. And I think they also benefit from the carriers who are subsidizing their products very significantly, especially the iPhone.
How much does that give them a competitive disadvantage against, say, Samsung at a time, especially when AI is becoming increasingly part of the conversation? If they're being forced to raise prices at a time when other areas are looking to cut and possibly offer better technologies?
Yeah, so I have a hard time believing that Apple is in a silo and Apple would be the only one that has to raise prices. You brought up the point of artificial intelligence. That has been a black eye for Apple, especially their ability to use artificial intelligence for a much needed upgrade for Siri. So I don't think Apple would be alone in raising price. So I'm less concerned about a situation where Apple's raising prices and Samsung isn't, and more concerned that Apple doesn't find a way to implement their artificial intelligence related upgrades to their ecosystem to draw in consumers in that regard.
Apple's a fantastic example, Tom, and I wonder if we can zoom out to understand Apple and how they're responding to some of these threats as a way to understand what large tech companies could do. Are they going to start investing in automation in the United States, even on the margins, even if they aren't going to bring production wholesale back to the United States? Do you see any investment coming on the backs of some of these threats?
Yeah, so at the minimum, we know that on the last earnings call, they identified 9 or 10 states where they're going to bring jobs. In many instances, having iPhone components made at those locations. But I do think when we talk about a U.S. assembled, because that's essentially what we're talking about, assembled iPhone, there's going to have to be a heavy level of automation. The good news for Apple is I think Tesla's a good poster child of this when you think about their regionalized manufacturing efforts in the U.S., in Europe, in China, and their emphasis of automation when we think of Optimus. So clearly, I think that if we see that U.S. assembled iPhone, there's going to have to be a fair level of automation to make it cost competitive with those across the globe.
Tom, as you know, that can take a while. So in between, the diplomat, Tim Cook, has got to do something. What can he do? What kind of investment commitments do you think he can make at the moment to make this all go away?
Yeah, so absolutely. So I do think, Jonathan, that what we might see here is an increase on that $500 billion commitment. What basically the Trump administration is offering Apple is a short-term reprieve on tariffs as it pertains to smartphones and computers. And what the Trump administration is offering all companies, including Apple, is lower corporate tax rates. So I think that a higher commitment beyond the $500 billion might be enough to seal the negotiation at this point in time.
Tom, let's finish on the name. 8-day losing run. Haven't seen a streak like this going back to 2022. Tom, what are you telling clients at the moment about how to value this company, given the headwinds it currently faces and the fact that its core piece of hardware went ex-growth a number of years ago?
Yeah, so you look at our $201 price target and our hold rating, we've got about a 28 times multiple on out-year earnings. I think the challenge is that even when things were going well for Apple, you were looking at a high 20s multiple and mid-single-digit earnings growth. An argument can be made that it deserves that high multiple given all the free cash flow it generates and a large portion of that free cash flow that goes back to buying back shares, paying dividends, things of that nature. I do worry on a near-term basis over the next 12 months that all this China risk isn't necessarily fully priced into the stock yet.
In what way should it be priced in, Tom?
A lower multiple. So I think at this point in time, an argument can be made. It certainly doesn't deserve a 30 times multiple, which is where it's traded at oftentimes over the last 12 months.
Tom Forte of Maxim Group. Tom, thank you, sir. Appreciate it. The CEO, no longer the diplomat, Tim Cook, not in a great place in the president's second term compared to where he was in the first term.
If he's being used as a pawn between India and the U.S. trade negotiations, very difficult to see what he can actually do. Tom Forte there was talking about potentially increasing that $500 million investment and possibly getting something more from that. But then how does that work with being used as a pawn? He doesn't really seem to have a good winning strategy other than just raising prices, especially phones that cost already about $1,500.
Which is something KeyBank and the analysts over there, the team over there, are expecting later on this year, potentially. Apple in the pre-market is bouncing back. It's higher by about 1.9% in early trading. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. German Chancellor Friedrich Merz says Ukraine has been given permission to use weapons given by its allies to strike deep inside Russia. Ukrainian President Volodymyr Zelensky has long pleaded for this authorization, which has gained added traction amid Russia's fresh set of attacks and Putin's reluctance to engage in serious talks. Meanwhile, Salesforce is closing in on an $8 billion deal to acquire Informatica. The Wall Street Journal reporting Salesforce is expected to pay $25 per share for the data management software company. And dozens of people were hospitalized in Liverpool after a car collided with pedestrians during a parade honoring the city's football team. A 53-year-old British man from the area was arrested, with police saying they believe him to be the driver of the car and that he acted alone. The incident is not being treated as terrorism. That's your Bloomberg brief. John?
Yahara, thank you. We'll be monitoring that story and bringing you updates as we have them. Up next on the program, waiting for September.
There's no question that the shock of tariffs are stagflationary. Is it going to be clear enough by September? I'm just not sure right now. Ultimately, we'll have to see what the data says.
Fed officials firmly on the sidelines. Up next on the program, Robert Sockin of Citi from New York City. You're watching Bloomberg TV. The fate of this market seemingly in the hands of one man and a social media account from day to day, minute to minute. The president going into the weekend, turning up the temperature, turning up the volume on the trade story, turning it back down over the weekend. Equities rally, bounced back up by 1.5% on the S&P, on the Nasdaq 100 up by 1.6. On the Russell this morning, the small caps up by 1.8. Under surveillance this morning, waiting for September.
There's no question that the shock of tariffs are stagflationary. Is it going to be clear enough by September? I'm just not sure right now. Ultimately, we'll have to see what the data says. Our monetary policy instruments either push up economic activity and inflation or push them both down at the same time. And that's a particularly challenging environment for policymakers to navigate. And that's why so many of my colleagues and I are saying we're really in a wait-and-see mode.
So here's the latest this morning. Federal Reserve President Neel Kashkari doubling down on the FOMC's wait-and-see stance. Robert Sockin of Citi downgrading his global growth outlook, saying ultimately the Fed is likely to put more weight on the risk to growth and start cutting again later this year. Robert joins us now for more. Rob, good morning.
Morning.
New York Fed President John Williams speaks later on this evening, incidentally, said recently that maybe you won't know until at least September what policy is actually going to look like, and they can't act until at least then. Do you think we'll have any clarity after the summer?
I think I have a lot of sympathy for the point that they're going to be fairly frozen during the summer, because right now the economy has been holding up fairly well. You've had a lot of front loading of purchases ahead of these tariffs. You're not seeing really a ton of evidence of it bleeding into prices yet. But I do think once we get into the summer, that data comes in, and especially later in the summer, you will start to see more definitively that prices have moved up due to these tariffs, and that growth is slowing down, both because that front loading of purchases has to be paid back and the tariffs themselves will slow activity. So I think by then they should have some clarity, and I expect they'll probably cut rates at that point. But there are a lot of moving parts, so it could take a little longer than that.
So let's go through it piece by piece. At the start of the year, the average tariff versus the average tariff now, and why you're making the assumption that a lot of that will result in higher prices in the months to come.
Yeah, absolutely. I mean, before President Trump took office, the average tariff rate on U.S. imports was around 2.5%. We estimate it's somewhere around 13% with announced policy so far, give or take, depending on some assumptions. When all's said and done, and you end up with probably a 10% minimum tariff on most countries, the sectoral tariffs in place, potentially more sectoral tariffs to come, you end up with something around 15% effective tariff rate by the end of the year. That's a lot better than we were maybe a few weeks ago when the possibility of 25% tariff rate was on the table. But that's still a substantial increase from where we were before, which is why we're fairly confident that these will have an effect on inflation. These will have an effect on growth. But you're not seeing that right now because of those distorting effects I mentioned, the front loading. And also companies are hesitant to put through price increases because they don't know how much of these tariffs are going to stick.
This has been the reason why it's so difficult to really game out how this is going to play out, because everyone's saying the data you can't rely on. So data dependency is out the window at a time when this was a uniquely data-dependent Federal Reserve. At what point does the data have to turn to back up your thesis that we are going to see some sort of slowdown?
Yeah, absolutely. And, and it's a difficult environment to read because you said this, the soft data have been telling one story. Those have weakened a lot. They're still weakening. But the hard data have been quite good. And not just on the spending side where you've been seeing the front loading, but in the labor market where you really haven't seen any layoff activity. Payrolls growth has still been fairly strong. I think I would be surprised if by the end of Q2, so if after June or beyond, that you don't start to see this weakness. If you're still seeing a lot of strength during that period, it could still be that the effects are delayed, but it might be that just the tariffs aren't having the same detrimental effect. The companies are finding ways to cut costs in other ways. Consumers are still being resilient. But ultimately, with the type of tariffs we're talking about, I think there has to be an economic cost, both in terms of higher prices and lower growth. Maybe it's not as large as we're thinking, but that cost is going to come eventually.
If that's the case, does that offset some of the deficit concerns with the one big beautiful bill? Because if you do have tariffs that stick, potentially, as we were hearing from Steve Chiavarone, the revenue raising aspect of that actually goes to support some of what spending there could ultimately be. So could that be a potential offset to some of that weakness?
Yeah, it's a great point. And, the tariffs aren't as large as we would have thought or the risks of them aren't going as high as we would have thought a few weeks ago. And it looks like what's coming out of Congress is maybe net somewhat more stimulative than I would have thought at the beginning of the year. I still think when I look at the numbers that even though effectively they could use those revenue to support other tax cuts, ultimately the tax cuts are not large enough to fully offset the cost of the tariffs. It'll help. But I still think even if you get this reconciliation bill that's somewhat stimulative, you're still going to have an economic slowdown later this year.
Somewhat stimulative. Just build on it. Which piece of the tax bill is stimulative? What are you looking at?
Well, the extension of the tax cuts from 2017 macroeconomically is not stimulative. It has a deficit cost, but those are the tax rates that prevail now. And so if we keep them, it's just preventing a fiscal tightening. But it's the other things that are kind of being debated, no tax on tips, these other sort of tax measures that, net would be stimulative. Again, it's unclear how large they're going to end up being at the end of the day. But I think with what's currently being debated, they're not large enough to offset the negative drag from the tariffs.
What the administration would like to see, what they're attempting to encourage, is an investment boom right here in the United States. A lot of money coming home, a lot of production coming home. Do you think that's achievable?
It's really challenging. Even in the data itself, we're not seeing that much evidence of it, even in things like when we do surveys, not seeing a whole lot of appetite. Now, maybe that's because this has been moving so fast and companies don't know what the environment's going to look like. When I talk to companies around the world, also not hearing a particularly large appetite for that. So maybe you'll see it on the margin in some areas. But even if it were to happen, I think it's a much longer term story that it takes years to plan and do these investments, and you're still living with the tariffs in the short term. So I'm skeptical that will work to bring back a large scale production. And even if it does, it's going to be a long time before you see those benefits.
There's sort of two ideas that have been baked into the market. On one hand, there's going to be a slowdown, and that's a good thing because that's going to cap some of the inflation. Then there's a slowdown, and that's going to be even worse because it's going to allow the stagflationary environment to go down. And then another group that says, well, if it's a slowdown and it's not recession, it's fine. It's okay. It's healthy. Where do you fit in with this? I mean, at what point is a slowdown really problematic versus just something that is natural, part of cycles, and could actually curb inflation?
Yeah, on the recession point, I think if we were going back again a few weeks ago where things looked even more uncertain, and especially around the worst case scenarios with where tariffs could go, we were warning of a pretty high risk of recession. I think that's diminished, and we're now more in the camp that you'll probably get some type of modest slowdown that's manageable, not recessionary, but recession risks are still on the table. I'm still in the camp that this will have a meaningful economic cost. Right now, we haven't seen that. A lot of it's been theoretical. But I do think you're going to see deterioration in the labor market. You're going to see the unemployment rate move higher, and you're going to have lower growth than you would have had otherwise if we didn't have this tariff policy and trade uncertainty. So ultimately, I think it's a difficult story. And I do think that you're going to have that stagflationary environment temporarily, which is going to put a lot of challenges on the Fed and markets in general. So net, I come down on that. If we didn't have this type of policy shift, we would have had growth probably above 2% in the U.S. and inflation near 2%, a gradually easing Fed. That's a much nicer environment that I think we're going to end up once we get to the second half of the year.
If we see that step down in global growth, where's that pain concentrated? Outside of U.S. borders?
Yeah, absolutely. And, right now it's largely in the developed markets. So, of course, the U.S., I think, feels a lot of the pain. After that, we have a fair amount of growth slowdown in Europe, especially compared to where we were a few months ago. A lot of that's due to this trade uncertainty that we're seeing persisting. Beyond that, we have relatively solid growth still in emerging markets. But if you get things like the reciprocal tariffs that Trump had threatened on April 2nd, if those come into play, you're going to see a significant markdown in emerging market growth because things like tariffs on Vietnam were threatened at very high levels. Korea, they export a lot to the U.S. Right now, we have solid growth there, but if those tariffs come back into play, that's where you're going to see a lot of markdowns.
Rob, appreciate the time. We'll see you July 9th. Maybe before then, obviously before then. Robert Sockin there of Citi. Thank you, sir. Up next on the programme, Roosevelt Bowman of Bernstein Private Wealth Management, Henrietta Treyz of Veda Partners. We'll catch up with Patrick de Haan of GasBuddy and Gennadiy Goldberg of TD from New York City. You're watching Bloomberg TV.
Feels like a lot of the good news was already priced in.
We still like U.S. stocks for the long run. I'm not talking about the end of U.S. exceptionalism.
There is literally no alternative to the U.S. dollar and U.S. assets.
The U.S. is your best investment destination.
Our view was one of U.S. exceptionalism would get long in the tooth, and so diversify your exposure.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 firmer, higher across the board here on the S&P, up by 1.4% as the president extends the tariff deadline for the Europeans. The Nasdaq up by 1.5%. In the bond market, stability a bounce back. Yields are lower by 5 basis points. The 10-year 446, 30s a break of 5% at 497. The rally born in Japan. The Ministry of Finance looking at maybe tweaking issuance in Japan, which is having some consequences worldwide this morning.
My narratives are getting scrambled. I just want to tell you, I can't tell whether I should focus on trade, whether I'm still focused on the big, beautiful bill from last week, or whether I'm focused on Japanese financial policy and their issuance of 40-year bonds, which are going to be issuing tomorrow, and their long-term trajectory for long bond issuance. It really comes to show we don't have a full understanding of what exactly is behind some of the moves that we've seen in the market that have been fundamentally undermining long-pinned beliefs in 60-40 and some of the investment theses that people have been having.
It's the return of an uncomfortable correlation, the breakdown between bonds and stock, and the fact that the two asset classes are moving in lockstep that has spooked some people. Japan's had a big role to play in all of this. It has been a global bond market story. You mentioned the 40-year supply coming out of Japan in the next 24 hours. Tomorrow, you'll get 5-year notes in America. The day after, 7-year notes as well. That's going to be in focus too after the very soft, can we call it very soft, 20-year auction that came out of the US just last week.
Do we get a sense of instability in terms of bond yields and a potential buyer strike at a time when we are talking about a fiscal deficit as well as trade policy that has left a lot of people's heads spinning? And I think that has been the fundamental question that a lot of people have been trying to answer. What struck me is that we're getting a different answer from every single fund manager who comes on the set. Some are saying, yes, I am fundamentally changing my view. I do see European and Canadian investors pulling back, rethinking their American investments. Other people saying that's hogwash. When they realize that they're going to put their money first, they're still going to come back to the U.S. because there is no alternative at the end of the day. And those are going to be the two competing narratives throughout the end of the year. And we're going to be using each auction to sort of lean on one side of the narrative or the other to justify it.
Going to be a very interesting summer. July 4th. July 4th is the goal, the ambition to get the tax bill through Congress. July 9th is when that 90-day period of discussions, negotiations between the US and the rest of the world regarding trade is complete. So by July, we should have a decent view of the world, shouldn't we?
I mean, sure. I guess that here's the question. What is that decent view of the world? Is it the big, beautiful bill? To me, I think that's probably more likely that we do get some semblance of what that looks like and how feasible that will be to get passed through the Senate. As far as the trade deals go, can you really get some resolution to the VAT tax, to the regulatory overhang, to the potential other regulations on U.S. tech companies in Europe quickly enough to get to that July 9th hurdle? That, I think, is a bigger question mark.
Equities this morning, at least, a calm start to Tuesday morning. We're doing better, up by 1.4% on the S&P 500 and a rally in the bond market. Coming up this hour, Roosevelt Bowman of Bernstein Private Wealth Management. As policy weighs on growth expectations, we'll catch up with Henrietta Treyz of Veda Partners on President Trump's EU tariff delay. And Gennadiy Goldberg of TD Securities as global bonds stage a comeback. We begin this hour with stocks higher. Following the president's tariff reprieve, Roosevelt Bowman of Bernstein Private Wealth Management writing, we anticipate weak US growth in 25 of about 0.5%, given the current higher cost of capital and the uncertainty around tariffs. Roosevelt joins us now for more. Roosevelt, good morning. It's good to see you.
Yeah, good morning, John. Good morning, Lisa.
Thank you for being here. A step down in US growth from around 3% to 0.5. Can you walk us through how well-priced bond markets are at the moment for a world of growth, in the US at least, of 0.5%?
I would argue not very well priced at all. I mean, I think when we look at where growth is likely to move over the next couple of months and really without policy support, we're talking about the tax bill, not quite there yet. And when you think from a monetary policy standpoint, the Fed not ready to cut because we haven't seen enough progress on the inflation front, you're likely to see some weaker labor and consumer data over that time that eventually pushes yields lower. I think the reason we haven't seen that yet is certainly that policy volatility. When you think about some of the potential legal challenges to replacing the Fed chair, thankfully that rhetoric has pulled back, but that's certainly kept yields, I think, elevated above levels that you would anticipate given the growth outlook going forward.
What are your assumptions on inflation with the growth outlook you're expecting?
So, I mean, our assumptions are inflation kind of remains elevated over the short term, but that when you look more 6 to 12 months out, that you don't have the kind of high inflation or even the stagflation that's talked about a lot. I think from our perspective, the reason that so many people are worried about it's understandable. You think about tariffs pushing up prices, but from our perspective, that only happens if consumers can meet the higher prices. And, I would challenge the consensus view that we've seen this dichotomy of soft data has been really weak and that the hard data has still come in fine. When you kind of look at some of the high frequency consumption data, credit card transactions, the ticket sizes associated with them, it's shown some real weakness in the consumer over the past couple of months. We're seeing that weakness in labor demand as well. When you look at online job postings, the salaries associated with them, they're both at 15-month lows. You look at Atlanta Fed wage data, that spread between those that are staying in their job and those that are leaving their job, it's just absolutely collapsed. So you're not getting any premium for leaving your job. The kind of the leverage has shifted from the employee back to the employer. That speaks to lower wages going forward, lower consumption, consumers not meeting those higher tariff-induced prices.
So this morning, it seems like there are a couple of schools of thought among investors who've come on the show. You've got Steve Chiavarone saying that actually he sees equities as a better bet than bonds right now because he does think that growth is going to reignite later this year. It sounds like, and correct me if I'm wrong, you actually prefer bonds later this year to equities if you do see growth meaningfully slowing and sending people back to what has been and maybe will continue to be a haven asset.
I actually think, Lisa, there's a pathway for both to kind of do better towards the end of the year. So to your point, once we have some slowing growth over the near term, I think that, and once we have policy kind of more sort of knowns about what the tax bill looks like, then you have the pathway cleared for bonds to do well. I think equities, you're going to take some type of stimulus and support, and that's more likely to be, I think, from the Fed than necessarily the tax bill. And that's more of a kind of fall and winter story where the Fed actually has a green light to cut from both the inflation standpoint and the weakening economic data.
So we were talking about this with Robert Sockin, just how quickly we can see the negativity bleed into data that has been very distorted by front loading and a whole host of other factors before people start to question this theory of a rolling over in an economy that has been incredibly resilient with companies adapting and adjusting and figuring out ways to keep on keeping on.
Well, I think we're starting to see some of that, as I mentioned, from both a consumer and labor standpoint. And as people are still concerned about their job prospects going forward, they're likely to pull back on their consumption. That's typically what we've seen in history. Even if we haven't observed so much of that in retail sales, there's been some weakness there. And again, I think the high frequency data have shown that consumers actually are pulling back and are not quite as resilient as maybe the top line figures have suggested.
So there's also this theory underpinning what you're talking about, which is that eventually money will go back into the U.S. and U.S. assets that have traditionally been havens. Why do you have that conviction at a time where people are selling the dollar and you are seeing a move out of U.S. assets, particularly among European and Canadian investment firms?
Well, I think we can separate, kind of fixed income and equities for a moment. So if you think about fixed income, understandably, there's been a premium there because of the policy volatility. So you may not see the size of the rally in bonds that you would normally anticipate with slower U.S. and global growth. I think equities from a long-term perspective, that is a tougher short because you're not just taking a geographic position, you're taking a sector position as well, given the U.S. leadership in technology. So, when we talk to our clients and saying, hey, do you want to be short technology for a 5-10 year period? The answer is a resounding no, understandably. So I think that is where we have confidence that, yes, there is a risk premium for U.S. assets that was not there before because of the trade and monetary policy volatility. But the idea that we have this mass divestment into other options, that's not our view at all. And I think that, I think number one, the depth and size of the U.S. bond market, and number two, the leadership in technology says that both U.S. fixed income and equities will be attractive going forward, just not as attractive as before.
What do you think the dollar weakness speaks to then? What do you think is ultimately behind it over the past few months?
I think in terms of the dollar weakness, for sure, that is where you can express more of that concern about policy volatility. And if you're thinking, and when you look at the dollar, it's undervalued over the short term, kind of based on, nominal interest rate differentials. But for longer term measures, you could argue that it's been overvalued for a while. So I think it's a combination of long-term overvaluation, short-term undervaluation, and you end up with some dollar weakness. I think the other part of it, too, is that the Fed, when you think about the range of outcomes for Fed policy, you're more waiting for them to cut. You don't have the other side of the distribution where you're saying, could there be price pressures that would have hikes that would really widen the interest rate gaps enough to overcome the policy volatility, so you end up with the dollar weakness that we're seeing right now.
They've certainly taken those hikes off the table, that's for sure. Roosevelt, this was great. Let's do it again soon.
Absolutely.
Good to see you. Thank you, sir. Roosevelt Bowman there of Bernstein Private Wealth Management. You will hear from John Williams, New York Fed President, over in Tokyo, Japan, a little bit later on this evening.
Evidently, the Japanese bond market is so important that the entire Federal Reserve is over in Japan right now talking about fiscal and monetary policy. It just sort of goes to show this is very much a global central bank territory, and maybe this is is really what's behind, I don't know, maybe it's the Japanese bond market that's been dictating all of the turmoil in the global bond market.
The Fed controls the front end and Japan controls the long end.
Actually,
we're doing this?
Actually, you know what?
Something like that.
You've got to trademark that, because I've got to say those life insurers, they've got a big role to play.
The bond bouncing back this morning, at least. Bonds worldwide, yields are lower across the board. Equities bouncing back too. Equity futures higher by 1.4%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. European auto sales fell significantly in the month of April, with none feeling the brunt more than Tesla. Sales of the EV maker fell by roughly half in the month, totaling just over 7,000 units as it continues to lose market share. At the same time, Chinese EV maker BYD outsold Teslas in the continent for the first time. Meanwhile, President Trump wants to cancel all federal funds directed to Harvard, according to the New York Times. The Trump administration has already frozen $2.6 billion in federal research money for Harvard and moved to block it from enrolling foreign students. Its actions are part of a broader effort to address what it perceives as rampant anti-Semitism at the Ivy League. And Charles Rangel, the longtime Democratic congressman from Harlem, has died at 94. As the first black member of the House Ways and Means Committee, Rangel championed tax legislation to benefit inner cities. House Minority Leader Hakeem Jeffries issued a statement calling Rangel a trailblazer, change agent, and champion for justice. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, President Trump backing down.
You spoke to European Commission President von der Leyen. Did you discuss the 50% tariff?
She just called me, as you know, and she asked for an extension on the June 1st date. And she said she wants to get down to serious negotiation.
And she got that extension. That conversation up next with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Stocks bouncing back from a 4-day slide on the S&P 500, positive here by 1.4%. On the Nasdaq, up by 1.5%. Apple, following an 8-day slide, is up by 1.6%. That's the name to watch going into the opening bound. Then, of course, we get earnings tomorrow, so look out for Nvidia later on in the week. In the bond market, you're probably wondering where fixed income is trading. It's trading better. Yields are lower by 5 basis points on a 10-year. We're down by 6 on a 30-year. A lot of speculation and reports that maybe the Ministry of Finance in Japan is considering tweaking bond issuance. That unleashed a big rally at the long end of the curve in Japan, which spilled over into worldwide global bond markets, including the Treasury market, with yields down across the board at the long end of the curve right here in the US. That's the situation in markets under surveillance this morning. President Trump is backing down.
You spoke to European Commission President von der Leyen. Did you discuss the 50% tariff?
She just called me, as you know, and she asked for an extension on the June 1st date. And she said she wants to get down to serious negotiation. We had a very nice call, and I agreed to move it. I agreed to do that, and that she said we will rapidly get together and see if we can work something out.
So here's the latest this morning. President Trump pushing back a tariff deadline with the European Union to July 9th from June 1st. The EU now looking to accelerate trade talks before 50% tariffs come into effect. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, we had a feeling things weren't going very well. The president has called the Europeans nasty, and in some cases nastier than the Chinese. Tyler, just what is at play here, and how big are the obstacles to a deal?
Yeah. Hey, John. Well, the stakes are high and the obstacles are also really high here, as we know that the White House has said that its frustration has been that they are negotiating with the European Union as a bloc. But meanwhile, the EU says that really at the end of the day, they don't have much clarity on exactly what the U.S. wants to see. We are starting to get some details about what's not going to be enough for a deal. For example, the U.S. rejected an updated proposal from the EU last week that would have done a range of things, but included both sides lowering their tariffs tariffs gradually down to zero for certain agricultural products and industrial goods. That was not enough for this White House, though we do know that the U.S. wants to see the EU boost its imports from these sectors, as well as in particular U.S. LNG. We do have new reporting this morning, people familiar telling Bloomberg News that the EU is going to start to tailor their approach to these negotiations to focus on some of those critical sectors, those industries that have been subject to Section 232 investigations from the U.S., like chips, autos, steel and aluminum, also importantly pharmaceuticals, one that we really should be watching closely here since it is a top export to the U.S. and something we're expecting President Trump to really renew his focus on in the coming weeks ahead of some additional sector-specific tariffs there. So, John, we're going to have to see how this really does work out because at the end of the day, we know the U.S. wants to see more progress on those non-tariff barriers like regulations, digital services taxes, how big tech companies are subject to fines from antitrust investigations. It really is a pretty wide range when it comes to this. And perhaps one of the biggest ones that President Trump has singled out, the VAT value-added tax, appears to be a red line.
Tyler, do we have a sense of how much the U.S. wants Europe to push back on cheap Chinese goods that are going into the region, or how much they want them to constrain trade with China going forward?
Well, the U.S. Openly has said that that's not going to be really the main focus here. But between the lines, we have seen some indications, including from that updated proposal that the EU did float to the U.S. last week. It didn't explicitly say that, but it did say that they would work when it comes to overcapacity, particularly on semiconductors. And there sort of was some reading between the lines here that that would have be used to help bolster against the broader argument to help build up against China. Ultimately, we're going to have to see if that ends up being such a big driving factor here, since, Lisa, there are just so many different things that they are contending with.
And Tyler Kendall with the latest in Washington. So we have some kind of deal with the UK, some kind of truce with the Chinese, and ultimately a bigger stick waiting for the Europeans. On July 9th, Henrietta Treyz of Veda Partners joins us now for more. So, Henrietta, when we get to July 9th, there's a big stick waiting for the EU now. How much will that incentivize talks in the weeks to come?
Yeah, absolutely. I mean, we had Liberation 1.0, and that created 10% tariffs on the entire world. And Liberation Day 2.0, I think, is going to be an increase or an uptick in tariffs around the globe, with a particular focus on the EU. I think they're one of the most at-risk nations right now, seeing higher tariff rates. And here's why. The president's threat for 50% tariffs is too high. It would cut off trade and be an effective embargo, just like we saw with China earlier in the year. But with the EU, we have a situation where the Liberation Day tariffs would bring them to 20%, and the sectoral tariffs would bring their number one export, pharmaceuticals, to 25%. That's the rate that President Trump has put Section 232 tariffs on everything from, beer cans to automobiles. So that's the direction that they're going. But 50% and that imposition rate would actually put pharmaceuticals at an advantage compared to other sectors, which is nonsensical. So effectively, my point here is that the entire threat of 50% never made sense in the first place. However, rates do need to rise up from 10% because they're not going to get a deal on the major agriculture components that have plagued the two nations for a century or more. So those are the negotiations that they need to take. It'll take some time, and I think tariffs have to rise first.
It begs the question, July 9th, we've got a self-imposed deadline. Do you see that as a deadline, or do you see reason to believe this is going to be an ongoing feature of the president's second term?
An ongoing feature, no question. I mean, South Korea, one of the allies that Secretary Bessent and Howard Lutnick have been saying we were going to get a deal on for 2 months now, has yet to come to fruition. And their own presidential contenders are saying we need a delay even after the June 3rd election. So even the sort of lowest hanging fruit nations, South Korea, Japan, even nations we already have free trade agreements with, have no deals. So my expectation is that across the board, we need at a minimum an extension of the 90-day reprieve with just the 10% tariffs. And I would definitely put that in quotes as we see the largest amount of revenue come in on Customs and Border Patrol in recent history from these tariffs. But they're all going to need to either be extended or, in the case of the EU, get a ratchet up and then also an extension.
Henrietta, we were speaking with Terry Haines earlier of Pangaea Policy, and he said that there was a geopolitical element to this as well. He talked about the potential for secondary sanctions on Russia to be held as some sort of negotiating chip in discussions with Europe. Do you agree with that? Do you think that increasing talk of the potential for additional sanctions on Russia could be part and parcel of some of these negotiations?
It's interesting you mentioned it that way. I was actually with some former administration officials over in London last week, and they were talking exactly about the price of gas where it is now. Where I am, it's $2.73 a gallon. You can actually start to impose secondary sanctions on Russian exports of oil to China or India or other nations and get that successfully done. There's a tremendous amount of pressure from Republican senators to move a sanctions package. This administration has been incredibly resistant to sanctions on Russia, but President Trump has obviously not been effective in ending the Ukraine-Russia war in 24 hours. As he promised on the campaign trail. And there's a long way to go there. So I think sanctions, especially as we get into like July and August, are going to become a real possibility and likelihood, and maybe something that the senators force the president to do after they pass this tax bill.
Do you think that, Henrietta, and this is one reason why I think a lot of people are trying to wrap their heads around what is and isn't a part of some of these trade negotiations, could this be used as a chip to go to the Europeans and say, look, we're actually taking a harder stance. Now give us better treatment when it comes to regulation around our tech companies, or give us better treatment when it comes to buying our chickens. I mean, do you think that that's sort of a relevant way of looking at some of these trade negotiations?
My favorite way to ingratiate myself to European clients is to talk about how they're never going to accept our genetically modified chickens or lower their phytosanitary standards. So I don't know that even this is enough to move the needle there. They take great pride in not taking our poultry, but certainly something to keep in the dialogue when it comes to digital services taxes and other pieces.
Henrietta, just want to finish on that tax bill. How you think things shake out in the end? We know the version that left the House. What does the version that leaves the Senate ultimately look like?
Looks like more deficit spend, shorter duration tax extensions on the things that Trump promised on the campaign trail, and some really fancy budget footwork, use of the current policy baseline, which I think the bond market is very aware of and not going to like very much. It's a rocky road ahead, but I've got 70% odds that this passes by the time we need to get to the debt ceiling hike, which is roughly July 24th in the House.
So later this summer. Henrietta, thank you. Henrietta Treyz there of Veda Partners, finishing on the bond market there and what could come out of the Senate. The 10-year, the yield is lower this morning, and it has absolutely nothing to do with Washington and a whole lot to do with Tokyo, Japan.
And what they're taking a page from Janet Yellen in a way, and what the Treasury Department did under her rule, which was when there was concerns about the deficit, just simply issue more in the front end of the yield curve. And maybe they're not going to go to that kind of extreme in Japan, but they've taken notice of what's happened in the Japanese bond market, and they want to maybe issue a bit less of the ultra long bond. Again, I mean, talk about a scrambled mind. So one day we're talking about the deficit jerking around the bond market. The next day we're talking about the Japanese Ministry of Finance jerking around the global bond market. It just highlights how we're in search of the correct narrative to frame a market that has been operating in some strange ways.
Because you can't reduce it to one single geography. It's been a global story. I think it's been pretty consistent over the last several weeks that Japan has been a big piece of this puzzle. Now, whether this takes this out of the picture completely, I don't know, but it's certainly an ongoing issue for the global bond market.
Although I completely agree with you, you pair that, though, with a weaker dollar. And that's the reason why people are talking about the deficit. And at what point do you end up with a U.S. problem, even if it is a global bond market sell-off? And I think that still is persistent, but you are correct. The Japanese seem to control the long end, and the Fed seems to control the short end.
The dollar stronger this morning against the euro. Euro dollar negative by a third of 1%, 113.48. Up next on the programme, Patrick DeHaan of GasBuddy on expectations for a busy summer travel season. That conversation just around the corner, live from New York. This is Bloomberg. It's a quiet, calm start to a shortened trading week. The calendar's light. Tomorrow, a read on the Fed's thinking, Fed minutes. The day after, a read on the labour market, jobless claims. The day after that, on Friday, a read on the inflation, PCE, and UMich consumer sentiment. Within that, of course, we look for those inflation expectations, which has basically become a political poll and no longer really an economic survey for many of you, I know. In the equity market, equity futures bouncing back by 1.4% on the S&P following a 4-day slide. The president causing a little bit of chaos for the equity market going into the weekend, threatening 50% tariffs on the EU, extending that deadline until July 9th, unlocking some gains this morning across the board on the Nasdaq 100 higher by 1.5%, unlocking some gains in the bond market. The Ministry of Finance in Japan A lot of people speculating whether they're about to tweak bond issuance, maybe lighten up on the long end, which would take some of the pressure away from the bond market worldwide. Yields lower stateside as well, down by 4 basis points. The 10-year 446, the 30-year a break of 5%. We're down 6 basis points on the session, 497.69. That's the cross-asset price action. We're 2 hours away from the cash open. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John, you mentioned the data we have coming this week, but perhaps the most important event comes after the close tomorrow, and that is NVIDIA earnings. You can see here shares up 2.4%. Ahead of that, you also had some Reuters reporting over the weekend that they're looking at offering cheaper Blackwell chips to China. China sales and what they can do to supplement it, given some of the restrictions, is going to be a big point of concentration in the earnings report tomorrow. Also, some deal news. Bloomberg before the weekend had covered and reported that Salesforce was looking at yet again buying Informatica. Well, we had some news from the Journal in the last hour that we are getting closer to that deal. They also put some numbers around it, about $25 a share. You can see in the pre-market we're trading just under that, so the premium not fully priced in, but those shares up 6%. Salesforce shares, those are up 1.6%. Finally, wrapping things up with AMC reporting that their Memorial Day weekend was the biggest haul of revenue that they've ever had for that particular holiday weekend. When it comes to attendance, it was its highest figures since 2013. They cited a new Lilo and Stitch movie, a new Mission Impossible movie. I'm going to be honest, I haven't seen that. The reviews are really mixed, and if you're going to convince me to sit for 3 hours, it needs to be near perfect.
Danny, I agree. Thank you. I did watch Mission Impossible, though, over the weekend.
You did?
And it was pretty decent.
Really?
Yeah.
3 hours?
Yeah,
Thought
all
that
3
it was
hours.
good? It was all worth it?
It was probably. Tom Cruise did it again, for me at least.
Was it just bubblegum? Was it basically bubblegum for 3 hours and it basically would deliver it on all the stunts really well?
By bubblegum, what do you mean by that?
That was really stimulating and you walk away not really thinking about anything?
No, this is a decent storyline.
Okay, all right,
Builds
good.
on. Did you watch the first part
Yes.
of? Okay.
So then it
built on it nicely.
Okay. Lovely, lovely. Look at that.
Endorsed.
Yeah.
All right.
80%.
Let's get to our top stories. On our radar this morning, President Trump saying he is, quote, absolutely considering new Russia sanctions after a third night of drone strikes. Trump posting on Truth Social, quote, Putin has gone absolutely crazy.
Yeah, and he went on to talk about this with reporters. I'm not happy with what Putin is doing. He's killing a lot of people. I don't know what the hell happened to Putin. I've known him a long time, always gotten along with him, but he's sending rockets into cities and killing people, and I don't like it at all. So here raises the question, is he willing to go the extra step for secondary sanctions? And to the point that we were just talking about with Henrietta Treyz, does the fact that oil prices are a lot lower give him the flexibility to actually engage with secondary sanctions, even if that could potentially raise oil prices?
And the relationship between this story and ultimately what happens in Europe on the trade front, I think, is important too. Just an update on that. The EU looking to accelerate US trade talks as President Trump extends the tariff deadline. Sources telling us here at Bloomberg, the European Commission is focusing on critical sectors, including autos, chips, and a whole lot more.
To me, it was really noteworthy that before the weekend, people didn't take it seriously that there were going to be 50% tariffs. Yes, there was a sell-off, but it wasn't as serious as you would think, given the fact that economists across Wall Street expected there to be some sort of de facto recession in Europe should these go through. The rebound, though, gives you a sense of how people do have faith that we are going to get some sort of semblance of something by July 9th, even though the laundry list of grievances is really quite long. And it's hard to understand how you get past some of these non-tariff barriers that are sort of entrenched in the system.
We've talked so much about what trade and these tariffs would mean for the US economy. We've got to talk about what it means for the European economy, too. European auto sales falling in April thanks to lackluster demand. Sales of gas and diesel models posting the biggest declines, outweighing EV growth, with the exception of Tesla, which saw sales roughly halved just last month.
And you saw China's BYD selling more EVs in the Euro region than Tesla for the first time on record last month. So it goes to really underscore this question around political protest driving some of the lack of Tesla sales. On a broader level, though, what's going on with auto sales in Europe is really telling in terms of consumer demand and just how much things are softening. And it raises a question. If people are going into European equities because they see that as the bastion of growth, is this a warning sign? If people don't have the conviction to buy cars at a time where a lot of people are saying if you wait, the prices are going to go up. I'm trying to wrap my head around that, and I'm not really making sense of it.
Then a warning for the Europeans came on Friday. Threat of 50% tariffs on Europe. That threat is going to hang over them until July 9th. And if you're long on Europe, you've got to tell me what the path ahead is if those tariffs go through.
And it raises the question, in the U.S., ahead of tariffs, you saw people buy more. You saw people buy more cars. You saw people stockpile more stuff. In Europe, is the response the opposite, to sit on your hands and stockpile cash? Why aren't you seeing that kind of front-loading behavior in Europe? And if that's the case, is there a greater degree of weakness under the hood that really is present in some of the economies?
That's the latest for the Europeans. Let's bring it home and turn to travel. GasBuddy predicting resilient road travel this summer. Despite ongoing economic uncertainty, the company which helps drivers track gas prices is predicting the average price per gallon will be just over $3 through Labor Day. GasBuddy's Patrick Haan joins us now for more. Patrick, welcome to the programme, sir. I know you just put out your travel survey for 2025. Just share some of the results of that survey with us this morning.
Oh, good morning. Great to be with you. Yeah, a lot of Americans going to be hitting the road, as we always do, for the summer driving season. 69% of respondents said that they'll be hitting the road at least once for a major road trip this summer. Now, that is down slightly from last year. 76% of Americans said that they'll be planning to hit the road last year. I think a lot of that is because of the economic uncertainty. Some of the trade war layoffs we've seen at some U.S. companies giving a little bit less confidence to Americans. But certainly for the 69% that is going to be hitting the roads this summer, it's going to be a good time. Average gas prices at their lowest summer level since the pandemic. And if you adjust for inflation now, Americans spending the least amount of time to fill their tank up, if you exclude COVID, since 2003, all of that giving confidence to the amount of Americans that are going to be hitting the road this summer, with 26 states now below $3 a gallon. As you mentioned, there is the possibility that we could even see the national average falling below $3 a gallon as we progress through the summer.
If that's the case, Patrick, does that speak to sort of a resilient mood in U.S. consumers at a time where there's speculation that there's going to be a fall off in the economic activity? Or is this domestic travelers deciding to stay home and use their cars rather than fly or engage in more expensive means of vacationing?
Well, I think consumers are a little bit caught right now between the headlines talking about trade uncertainty and which direction the economy may be going in. Consumer sentiment is still rather low, but then you have a subset of users, at least the GasBuddy users, who are very optimistic that low gas prices are kind of leading to this rare circumstance that, hey, the economy is still strong and we're going to hit the road this summer. In fact, nearly 50% of respondents said that they'll be traveling for more than one major road trip this summer. And this comes against a backdrop. Like I said, the national average could actually fall below $3 a gallon as we progress through the summer. And it's those uncertain headlines that could lead to those lower prices. That is, as we mentioned here, the price of oil, a big factor. Will there be a nuclear deal with Iran? That's certainly on the table. President Trump hinting that something could be close there. The price of oil this morning still struggling for direction. As you mentioned, though, also Russia, potential sanctions are something that are going to be watched as well for this summer, as that may prevent gas prices from falling below $3 a gallon if Trump were to put sanctions on Russia's crude oil.
Can you build on that, Patrick? At what level do gas prices have to stay for people to really travel in the amounts that you're expecting for all of those 2 road trips going over the summer? Is it sort of $3.50? Is it $4 a gallon?
Well, I think as the price of gasoline has fallen really for the third straight Memorial Day weekend, right, since peaking in 2022, Americans are starting to establish a new sense of normal. And for that new sense of normal, are having to see gas prices stay in the low $3 range. Gas prices have been remarkably stable so far this year. So if we start to see prices inching back up towards that mid $3 a gallon range, combined with economic uncertainty, you could see more Americans saying, well, maybe I won't take the risk this summer. But if you see the national average falling below $3 a gallon, the headlines will likely follow. And that probably will instill some consumer confidence for later this year that potentially we will hit the road. So I think the $3 a gallon mark is a very critical psychological point for many Americans. If we do go a little bit higher, that may be enough to shake the confidence of some who are on the fence with the economy still a little bit stuck in neutral as well.
Hey, Patrick, appreciate the update. Let's do it again soon. Patrick Haan there of GasBuddy on the latest for energy prices across this country. That one right there, a key focus for this president, as we know, who repeats these stats repeatedly.
Yeah, well, he also talks about $1.98 a gallon.
Which we can't find, granted.
Which, yes, has been difficult to find. Although when I was in Texas last week, it is really cheap. It is below $3. It is about $2.50 per gallon. And you do have to wonder at what point that offsets some of the concerns about higher prices and, frankly, enables companies to, on the margins, and I'm thinking of Walmart, kick up prices just a touch because people have that extra money in their balance accounts.
It provides consumers with some comfort at a time when they've been very squeezed for a number of years. That's the latest on gas prices in this country with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Arnott. Hey, Yahara.
Hi, John. King Charles has arrived in Canada to open a new parliamentary session at the invitation of Prime Minister Mark Carney. The king is expected to read the throne speech written by Carney's office that will lay out his government's priorities, including a push to negotiate a new economic and security relationship with the U.S. Meanwhile, for the first time in half a century, Southwest is ending its two bags fly free policy. Starting tomorrow, customers will have to pay for checked bags. According to Reuters, it will cost $35 for one checked bag and $45 for the second. The airline has also overhauled its open seating policy and debuted basic economy tickets over the past year. And a record-breaking weekend at the box office. Disney's remake of Lilo & Stitch led domestic ticket sales, with the latest installment of the Mission Impossible franchise coming in second. According to Box Office Tracker, ComScore, domestic ticket sales totaled over $326 million for the long weekend. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, global bonds bouncing back.
If you have a perception as a debt issuer that the long end of the curve is not popular and the depth of demand isn't there, why waste money by borrowing expensive money? It just makes sense to me not to keep on trying to sell bonds that people don't want.
The long end is popular this morning. We'll talk about why in just a moment. Gennadiy Goldberg of TD Securities joins us next. Live from New York City, you're watching Bloomberg TV. Coming off the back of the biggest one-week loss on the S&P 500 since Liberation Day week at the start of April, we're bouncing back this morning by 1.5% following a four-day slide on the S&P. On the Nasdaq 100, higher by 1.6%. In the bond market, 10-year and 30-year bond yields up for a fourth week last week. Haven't seen that all year. This morning, waking up with lower yields, down 4 basis points on a 10-year, 447 on 30s, 497. 90. Under surveillance this morning, global bonds bouncing back.
If you have a perception as a debt issuer that the long end of the curve is not popular and the depth of demand isn't there, why waste money by borrowing expensive money? If you're a central bank, you tell your debt office, back us, we'll have inflation under control over the medium term, and these yields, these rates we have now won't last forever. It just makes sense to me not to keep on trying to sell bonds that people don't want.
So here's the latest this morning. Global bonds staging a comeback. Yields lower across Asia, Europe and the United States as Japan looks to stabilise the bond market. Gennadiy Goldberg of TD Securities writing this. As market attention shifts back to softening economic data, we expect rates to move notably lower. Gennadiy joins us now for more. Gennadiy, good morning. Good to see you.
Thanks for having me.
This rally, as you know, born out of Tokyo, Japan. Overnight, the Ministry of Finance focused on supply and maybe thinking about tweaking issuance. How powerful would that be for the global bond market?
It's a pretty good warning signal. I mean, I think it tells you not only is the MOF looking at potentially changing issuance patterns, other treasuries could be as well. You know, you could see the same thing come out of the UK. You could see Scott Bessent actually notably say that, you know, the Treasury is considering lowering 20 and 30-year auction sizes, and that would really decrease the pressure on the long end. And that would kind of fly in the face of this almost inevitable, you know, pressure that we keep seeing over the last couple of months that rates must go higher because term premium must go higher.
Kit Cheese of SocGen, just in that clip there, put it well. Why issue bonds that people don't want? Maybe we should start there. Why don't people want them? What is going on at the long end of the curve that investors just don't like?
Well, I think there's a lot of supply. first of all. I think, deficits globally are going higher. You are seeing global central banks raise interest rates overall. What you're seeing is it's not that people don't want them, it's that people want more compensation for holding them. It's term premium that's rising. What people also forget is that once you see economic data start to move around, that tends to drive bond markets more than supply. I would say it's about 90-10, 90% macro, 10% of supply. And right now, the focus is almost exclusively on that 10%. If you see economic data start to soften a little bit over the course of the next couple of months, you could see rates move materially lower, even as term premium stays higher. So that premium is going to stay high, but rates overall could shift a bit lower as well.
So just to sort of walk us through and build on that in terms of how you're actually investing, are you going into longer duration bonds with the expectation that the economic data will roll over and that there will be issuance management by treasuries around the world?
Well, so I think you can see some issuance management. I think the 20 and 30-year are particularly subject to it. You could see Scott Bessent announce that the Treasury's considering for example, reducing 20 and 30-year auction issuance and issuing more bills over the next couple of years. I think the 10-year is a particularly interesting point. I think the 10-year is always in demand, and there's a lot of clients that I've spoken to who are considering these levels as particularly interesting. The issue is everyone's kind of worried about all of the supply, all these deficits coming to market. If there's a little bit of reassurance from the powers that be that maybe there won't be quite as much supply in the long end, they would feel more comfortable actually allocating cash to that part of the curve.
Okay. I find it really interesting that you talked about the 10-year and not the 30-year. Nobody wants to buy the 30-year.
No.
We have asked so many people, do you want to buy the 30-year here? Not one person. John, has one person come on the show and said, yes, I want the 30-year. I think it's very attractive.
Priya Misra called it a risk asset. Is it a risk asset?
Oh, absolutely. I think right now it's a risk asset because no one's quite sure where the bounds are. You haven't seen Secretary Bessent step up and try to defend 30-year or the 20-year rates. You've seen him talk about a little bit more in terms of buybacks. You haven't really seen them shift towards what I think is the more powerful tool is actually decreasing that long end supply. That would reassure people that perhaps there is a line in the sand. And that would, I think, get a lot of people taking a bit of a risk.
Do these forces force corrective action down in Washington, given the bill that's going through Congress at the moment?
I think right now, any sort of corrective action is tough to see. You're not really seeing a lot of fiscal conservatism. You're seeing a lot of the right messaging out of the Senate at the moment, but you're not really seeing that be pervasive. I think, unfortunately, right now, if there is an impediment down in Capitol Hill, the solution is to spend more, not spend less. So until we see some sort of, whether it's a bond market crisis or something like that, I don't really think Congress is going to be looking to actually decrease supply materially. But Treasury could by issuing more bills and really taking some pressure off that long end of the curve.
At what point is this bill stimulative in a way that will keep the economic data from turning and actually causing that rally in the bond market like you're expecting?
I mean, the issue with the kind of the stimulative part of it is that a lot of this is tax breaks for some of the population, not all the population, while at the same time, trade policy is still quite a problem for most folks. So you're seeing kind of a twofold market. One is you're seeing higher tariffs effectively right at the start, and then you're seeing some relief later, and it's unclear what that policy lag is going to be. So my worry is that by the time those tax cuts actually come about, you may already see data weakening as investors have pulled forward purchases and they're not really, in the mood to continue to spend money.
When do you need to start seeing the hard data weaken to believe that actually is what's going to happen? Because a lot of people have been saying this is distorted data. You can't actually depend on it. When can we get a clean read?
I think in the next couple of months. What we've been seeing in the last month or two is pulling forward, right? So investors have been buying up iPhones and all sort of capital goods in anticipation of higher prices. What you're going to see in the next couple of months is kind of the hangover from that. How much should they pull forward from Q3, Q4? I think in the next few months, you are going to see some of the hard data start to moderate. You may even see soft data recover, but maybe not to the levels that you saw before all this uncertainty started. So we're going to kind of converge in the middle. We're looking for 10-year at 4% by the end of the year. We're not looking for a recession. We're looking for a bit of a growth slowdown. To remind markets that this isn't kind of all boom all the time. You are going to see rates come down a little bit as the data starts to moderate.
10-year takes a step down to 4, about 4.46 right now. Where's the Fed in that world?
We've got 2 Fed rate cuts penciled in for this year, one in October, one for December. By that point, you should see the inflation pass-through stabilize. You should see inflation actually top out around 3.7, 3.8% year on year. The Fed should see that that is indeed transitory, shall we say, and then actually feel a little bit more comfortable coming in.
How they'll know?
We're going to see on a month-to-month basis, 0.5s, 0.6s, maybe even 0.7s for a couple of months. Given that this is probably going to be kind of a one-off type of transmission, by the time you get to really August and September, you should be starting to see that moderate. And if that's the case, they'll see that one-time shock, and they'll feel a little bit better about actually taking rates lower if the growth data starts to moderate.
You sound pretty constructive, particularly on 10-year bonds. Why then did you raise your forecast recently for 10-year Treasury yields by year-end to be 4% rather than 3.3% previously?
Look, the environment keeps changing. We continue to keep abreast of new developments all the time. We saw a pretty significant, I would say, de-escalation in trade policy. Or at least right now, I would call it a bit of a détente. If that persists, I think that's the way we play it. If there's more uncertainty in play, rates could certainly be biased to the downside. I think the issue is right now, we're really waiting and hinging on what the administration does with trade. And if trade is resolved in a kind of I would say, a peaceful way, you will continue to see rates elevated. If trade continues to cause more uncertainty and more problems, where it poses more downside growth risks, then you could see rates actually move a bit lower.
But you believe the higher the tariff, the lower the yield?
I think there's a certain point where, as you get tariffs really, really high, then, of course, that's going to be kind of a disruptive influence on consumers and on the bond market as well. It is a bit of a game, unfortunately, at this point, where you see investors really reacting to whatever the news of the day is. It's really hard for a lot of investors to capital plan. Both businesses, consumers, and investors, all of us are struggling because we're basically forced to digest whatever the overnight headlines are in anticipation of the investment priorities.
It's basically 2025. Welcome to 2025. It's an ongoing situation. Gennadiy, it's good to see you, as always. Gennadiy Goldberg of TD Securities. We flip from tariffs to taxes, back to tariffs again. There'll be a price to pay for that kind of volatility, and we'll get a sense of that, I imagine, in the next several months.
When I talk to corporate executives, some of them say, look, we've got to keep up our plans because we can't move on a dime the way that the president's policies shift on a day-to-day basis. On the margins, though, why would you do that extra plan? Why would you go for that incredible investment expansion? Mergers and acquisitions, especially larger ones, have been put on hold. That's the kind of stuff people are watching to really understand how open capital markets are to ambition at a time of a lot of uncertainty.
It's really hard to commit if you don't know the rules of the game. That's for sure. Up next on the programme, Biel of Kayne Rudnick, the Nyse president, Lynn Martin, Stephanie Roth of Wolfe Research, and Amanda Lynam of BlackRock. With equity futures bouncing back this Tuesday morning, equity futures up by 1.5%. Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance is up next.
Back to tariffs on.
Of all the countries who are lining up for a deal with the United States, the European Union is going to have the hardest time.
We're also waiting for just more clarity around what the tariff policies will eventually look like.
We've seen tariff, commentary change, not just week to week, but day to day.
Tariffs, we are still waiting to see the actual effects of tariffs, both on earnings and on the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The commentary changes from hour to hour, never mind day to day. Live from New York City this morning. Good morning. The third hour of Bloomberg Surveillance starts right now, and your week ahead is shaping up as follows. On the earnings front, Nvidia just around the corner. That drops tomorrow. On the Federal Reserve, FOMC minutes as well. On the labour market on Thursday, jobless claims. On Friday, a read on inflation. PCE, And the UMich Consumer Confidence Survey has read on sentiment going into the weekend. Before we get to all of that, here's the price action right here, right now. Equity futures on the S&P bouncing back by 1.4% as the president extends the tariff deadline for the Europeans. In the bond market, some support coming from Tokyo, Japan. Some support offering a rally in the bond market in Japan, in Europe, in the US as well. Yields down around the world.
The Ministry of Finance over in Japan considering reducing long-term bond issuance in response to the surge in long-term bonds that we have seen over the past couple of months. And this comes ahead of their 40-year auction, which is tomorrow. It also comes ahead of a slew of auctions in the United States throughout the week. You didn't mention those in the week ahead, but people will be watching those to understand not necessarily the 2-year auction today or the 5-year auction tomorrow, but the 7-year auction on Thursday should get interesting given some of what we've seen.
Heavy slate of supply coming worldwide, and it's important because it comes at a time when we're pushing this bill through Congress, which is pushing some pressure on the bond market, and maybe some of that pressure can be alleviated by the Japanese officials. The Secretary of the Treasury, Scott Bessent, needs a helping hand from the Ministry of Finance in Japan.
And Scott Bessent's been talking about how it very much is a global market. We were just talking to Gennadiy Goldberg about what drives the bond market. I think it's important to go back to first principles and try to understand this. He said it's about 10% supply. It's about 90% economic data. We haven't seen the economic data turn, so it's all really being driven by the supply story. It really goes to the show that if the economic data turns, all of a sudden we'll forget about the supply, and that really will turn back to just what is the state of the economy and what is the risk reward in risk-free assets, I put in quotes because we can debate that all year, and we have been in terms of bonds versus stocks, which have been something of the hedge against inflation and some of these concerns with deficits.
In very simple terms, that is the ultimate test for the bond market. The definition, for me at least, of what a developed bond market actually is. When things go wrong, do people buy the debt or sell the debt? When things go wrong, will you buy treasuries? Gennadiy Goldberg at TD is making the argument that if things go wrong and the data worsens, people will buy bonds, yields will drop, and he sees us going back to 4% sometime soon on a 10-year.
And he believed, as you pointed out, that the higher tariffs go, the lower bond yields ultimately go because the more pain will be inflicted on the overall economy. That's going to be the test, right? And it really depends on what other narratives are competing at that moment with that weaker economic data. If there is inflation, if the supply doesn't change, there still is a lot of long-term issuance.
Bonds this morning doing better. At the long end of the curve, we're down 5 or 6 basis points on 30s to 498. On 10s, we're down by 4 basis points to 447. Coming up this hour, we'll catch up with Biel of Kayne Anderson Rudnick. With stocks looking to snap a 4-day losing streak, the president of the New York Stock Exchange, Lynn, on weathering market volatility, and Stephanie Roth of Wolfe Research on risks facing the U.S. economy. We begin this hour with bonds rallying and stocks bouncing back. Biel of Kayne Anderson Rudnick writing the following: the market's attention has shifted from tariffs to rates, which makes sense, but we need to recognize some of the damage done to the system. Judy joins us now for more. Judy, welcome back. It's been too long. It's good to see you. Let's talk about that. The narrative flipping back and forth. What's the price to pay for the policy volatility of the previous 2 months?
Well, I think, the damage has really been done in terms of supply chains. And, we're all supply chain experts post-COVID, right? We all know everything about it. But if you look at port volumes, which are easy to track, you can see that there is so much volatility. It looks like a snake that's eaten all kinds of things. And the thing is that creates a ton of efficiency. You literally have companies that aren't even taking delivery of goods because they're waiting to see where tariff rates are. So it's a whole lot of energy and noise for nothing, right? For what used to be very smooth, efficient markets. And so my concern is that no matter what, when you create this level of difficulty in logistics, you raise prices, right? It's just the costs have to go up.
So, Julie, do you see any of that in the data? We don't see it at the surface level in the hard data. Do you see it in the company margins? As we exit earnings season, is any of this pressure starting to show up?
So I think, the thing that's really tricky for us right now is that if we think about valuations where we are, we're still at a pretty high level. And that makes sense to me because we have peak margins, right? And post earnings, we're probably down 30 basis points from our peak of, mid 17s. So it's not, dramatic, but you are hearing companies saying, We have higher costs. We have some concerns about that. And I think you've seen so many companies that have just pulled guidance entirely because they just can't predict where they're going to end up, neither on the demand side nor on the cost side. And so that creates a certain amount of friction for us and concern because so much of these higher valuations in the US are held up by higher margins and profitability that we enjoy here that the rest of the world is kind of in envy of.
That said, Julia, and this is something we've been talking about throughout the morning, we've been discussing the potential headwinds to U.S. growth. And yet, if you want to bet on tech, you've got to come to the United States based on the composition of the index. And that's basically been the reason why people say the premium will continue to exist, because where else are you going to get that concentration of the tech behemoths than the U.S. equity markets? How much of an argument is that for you?
I think that's an incredibly reasonable argument. And I would say that it's not even just technology, right? It's the depth of our consumer market. It's the depth of our research universities that support those technology markets, right? It's the dynamism of our labor markets that are the envy of Europe, right? You can't, you can say, all right, so, the US, it's not as shiny as it once was, right? But that doesn't change that we still have a real estate situation in China that's pretty difficult. So I think, yes, it's true. The shine on the penny is not quite as what it was, but still you have a really strong, dynamic, large market that's pretty important. And to me, all you have to look at is just the return on equity that our companies are able to generate. They're just higher than anywhere else in the world.
So given that kind of context, what are you looking for in NVIDIA's earnings tomorrow to give you the sense that there is more room to run in terms of the rally versus, wait a second, maybe we've overplayed how quick this AI adoption and revolution really is?
Yeah, I think understanding the depth of demand is really important, and more important than anything else, right? It's understanding how wide the demand is for them beyond the largest customers, right? We still have customer concentration concerns with this company. It's, for sure the level of the technology surpasses anything else, and the switching costs of using that technology are high. But we have a lot of companies that are trying to switch out and make their own technology in these hyperscalers. So if the depth of demand goes beyond those hyperscalers, that makes us more confident that, there really is room to grow here. But again, you're really paying for both that growth and the ability to maintain and protect these margins. And so that's really kind of the question, is just the depth of demand and how many companies are continuing to seek out this technology.
Well, Julie, this is the issue, and this is a theme that's come up on this program before, and I'd love you to build on it. The biggest threat for NVIDIA could come from their biggest customers. Just how do you play that in financial markets in the years to come?
I think that the real difficulty for them is they've made this decision to price at a very high level, and that invites competition. And it can be from their own customers who really have a lot of technical capabilities themselves. There isn't a ton of risk in the immediate near term, right? Because the thing that's so fantastic about their technology is the flexibility. And most of their competitors, that is, Amazon and Google, are building ASIC chips that are going to be less flexible. If AI moves in a direction that requires more flexibility, that's going to favor NVIDIA. So I don't have a ton of concern from a competition standpoint. Where I have concern for NVIDIA is just the size and the depth of the market. To me, that's a bigger issue than whether or not they're going to be usurped.
I also am curious about what their commentary is going to be about some of the tariffs and some of the international backdrop, given that Jensen Huang was the one who had the hot seat, but also the great seat of being next to President Trump on this trip across the Middle East, even though Tim Cook seemed to be left on the sidelines wondering, what about us? How much does that give them an advantage? And what are you expecting to hear when it comes to trade, especially because a lot of companies have taken different tacks to differing results?
Yeah, I think it's really, really difficult, right? There is a risk of being seated next to President Trump in terms of the level of attention that you get, right? I think there's probably something in Tim Cook that wishes that he hadn't actually pursued this relationship quite as aggressively as he had, because the minute he's moving in directions that don't make the president happy, the minute he's going to be punished and called out specifically for having his own tariffs, your own private tariffs. Good for you, right? So I think that's a real challenge in terms of you would like to have the level of influence and support that the president can give you. But at the same time, if you make any action that moves counter to what his agenda will be, you will feel the wrath of it. So I think a lot of our big tech community are recognizing that they have to be a little bit thoughtful and a little bit strategic in how they deal with the president.
What's your strategic advice, not on how to deal with the president, but on how to deal with the dispersion within Mag 7, Judy, that comes about because of some of these issues?
You know, I think that the real thing is that it's multi-layered, right? It's really complex. All of these companies, we talk about them like they're a monolith, right? But their ability to leverage AI is very different among themselves, right? There's nothing really in Facebook's business model that requires AI to work. For Google, it's existential. It's their very essence and their right to maintain this quasi-monopoly on search. If it gets usurped by AI, which it really looks like it might, that's existential for them. And I think that's why the multiples are what they are for those two companies. The real question is, to me, is whether Apple is going to do what it kind of always does, which is be a fast follower, because its first forays into AI have not been great. I don't know about those text summaries, but I don't know a single person that enjoys them.
Judy, it's good to have you back on the programme. We'll do it again soon. Judy Biel there of Kayne Anderson Rudnick. Here on the last point, right?
Yeah, well, I mean, look, all I can say is Siri wasn't fantastic. The AI adoption we've seen so far. Yeah, you know, the only thing is my mother's name is close to Siri, so every time I say her name, my phone starts to get really excited. So
you switched it off?
It just gets really excited. I actually haven't switched it off. I probably should.
That was a little bubble. Just put a different name in for your mum.
That's true. That's probably wise. You know.
See what happens.
Okay, thank you for the advice.
You pick the name, though. Apple is up by 1.7% this morning. Something nice, obviously. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. European auto sales dipped significantly in the month of April, with none feeling the brunt more than Tesla. Sales of the EV maker fell by roughly half in the month, totaling just over 7,000 units as it continues to lose market share. At the same time, Chinese EV maker BYD outsold Teslas in the continent for the first time. HSBC cut more than 24 analysts, and those affected include Stephen Major, a frequent guest on our network. That's according to sources who tell us here at Bloomberg it was part of a sweeping restructuring of its investment banking unit. The restructuring, led by CEO George El-Hedary, is expected to lead to $1.8 billion in charges over the next 2 years. And in sports, the Oklahoma City Thunder are one win away from the NBA Finals after beating the Minnesota Timberwolves in Game 4 of the Western Finals. League MVP Shai Gilgeous-Alexander and first-time All-Star Jalen Williams combined for 74 points. Playoff action continues tonight with the Knicks and Pacers playing Game 4 in Indianapolis. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the programme, the Morning Calls. Plus, we'll catch up with the Nyse president, Lynn Martin, in just a moment. From New York City this morning, good morning to you all. This is Bloomberg. The opening bout, 1 hour and 14 minutes away. Equity futures on the S&P bouncing back by 1.4%. Lower into the weekend, down for 4 consecutive days. Down off the back of the president's social media posts, ramping up the pressure on the Europeans and then taking it back over the weekend, and we snap back. That's basically the story in equities.
Yeah, I mean, Ursula von der Leyen asked for an extension and he gave it to her. And so that's that. And that seems to be what's giving everyone a lot of excitement.
Last week, stocks down, bonds down, yields up. This morning, stocks up, bonds up, yields down. Yields down by 4 basis points. On 10s, down by 6. On 30s. That correlation sticks. Equities and bonds are still moving in lockstep.
You know, what's interesting to me is it's not because of necessarily trade becoming less tense than it was on Friday. This is because of issuance plans, potentially, by Japan. What stories are going to stick? A, trade uncertainty. We're not going to resolve this in the next couple of weeks. And B, the idea of treasuries around the world being able to adjust their issuance in response to some of the questions around the long end of the yield curve. Those two stories, I think, are going to stick, and people are trying to plan around those because that is something you can hang your hat on.
I imagine the Treasury Secretary, Scott Bessent, is waking up this morning with a bit of a smile. I'm not saying that these are part of discussions, negotiations over trade, but I'm sure this is welcome news for the US and the Treasury specifically.
And it underscores what he has said before, which is this is a global bond market, and stop looking at us and blaming us for everything. Go look at Japan.
Blame Tokyo. Yields are down this morning by 4 basis points. That's the price action. Don't blame Tokyo for everything. It's a wonderful place. Time now for the morning calls.
Never
First
been
up,
there.
Raymond James lowering its price target on Abercrombie and Fitch to 90, saying channel checks now show lingering softness at its flagship brand. That stock is up by more than 1%. Your second call from Guggenheim, lowering its price target on target to 115, citing an uncertain outlook following the company's earnings. That name is bouncing back still by about 1%. And finally, Jefferies upgrading Southwest to hold, expecting shares to benefit after a string of strategy changes. That stock is up by 2.6%. Paying for luggage apparently is a strategy change.
Yeah, the strategy changes to basically make people pay for less. I mean, honestly, Southwest has also been trying to shift more into the more expensive part of the cabin. But again, I just wonder how much they could do
Just
this.
imagine the boarding chaos now, because no one wants to pay to put it in the hold.
You know,
Everyone wants to put it over in the overhead bins.
I saw a new one that they weren't allowing people on once the overhead bins were completely full. They said, if you still have your suitcase and it doesn't fit, take the next plane.
I call them bag Nazis at the front gate. You know, at the gate before you board, and they spot the suit.
Yeah.
And they want to shove the suit
That
into the
made a
bag.
big impression on you, didn't it?
Drives me insane. I watched them do it to John Hamm, you know.
Really?
Yeah. He came on the plane, rightly a bit annoyed, and then they came up to him because he was a bit annoyed, and do you know what they offered to do? Hang his suit up. So do you know what he had to do? Take it back
Take it out of the bag.
Come on.
All wrinkled.
The people on the plane get it. They're like, can I hang up your suit jacket? But boarding the plane, they're like, no, you've got to put that in your bag. Make sense of that.
Let's have somebody call in. Please call in if you're a gate agent and you have personal thoughts about this, and you can respond.
We'll do this another time. Let's turn to the IPO market. Mountain and Hinge Health making strong trading debuts on the Nyse last week, both pricing at the top of their ranges and seeing strong demand despite ongoing uncertainty around tariffs and consumer health. Joining us now, the president of the New York Stock Exchange, Lynn Martin. Lynn, it's good to see you.
Great to be here.
Before we get to these trading debuts and maybe some IPOs coming through, I just want to talk to you about the amount of volume that's come through your business through the year so far. Just walk us through it.
Yeah, if I look back on this year, it's been a year unlike any other, both from the demands on our system and the liquidity in our system manifesting itself in trading volumes. Now, if you look at that period between Liberation Day and the pause, we saw records in terms of messaging traffic, hitting around 1.2 trillion incoming order messages that we processed with 30 microseconds median response time on 2 of those days. And then if you look at the amount of transactions that occurred on our platform and the equity markets as a whole, I mean, an average day is around 16 billion trades. And now, during that period, we had 30 billion. It's just unprecedented. It's more than 2 times the amount of volume, both from execution, from actual trades, as well as from messaging, than we saw during COVID. Now, you remember how active COVID was. And there's been a variety of reasons why we've seen that, I think.
Do you think it's something we take for granted? The infrastructure holding up in the way it has done?
I think it's something that we at the NYSE spend a tremendous amount of time thinking about and planning for. We hope you take it for granted because that means we're doing our job. Our job is to ensure that the markets are open and efficient so you can manage risk, particularly during those incredibly uncertain times like we saw in April.
We saw an incredible amount of volume on the secondary markets of existing companies that have existing shares. This was supposed to be the year of IPOs, of deals, of all sorts of capital markets activity. Where are we in that? Are we seeing a revival of that as people get a little bit more confidence around trade? Or is it still really kind of being iced?
Yeah, so initially this year when I was with you both in Davos, I was incredibly excited. You know, I still am really excited about the IPO markets. I think Mountain and Hinge last week going and doing so incredibly well, both pricing at the high end of the range, both up significantly over their IPO prices just in their first 2 days of trading, are the sign of what I was talking about with you both in Davos, and that there's a tremendous amount of demand for new issuance in the market. Portfolio managers I talk to, long-only funds I talk to, they want new issues in the market. So I think you're starting to see these companies now come to market. Now that the VIX has come back to earth, come back to that 20-ish level, and you're not seeing as much of the intraday swings as a result.
You talked about Davos. I'm just wondering, the enthusiasm you had then, can you give a sense of how much lower the volume of IPOs or deals you expect to be for the remainder of this year now than, say, in January, based on the uncertainty and based on what hasn't gotten done over the first half of the year?
I'm actually still optimistic that the same amount of IPOs will go. It's just shifted out. If I look in the case of Mountain and Hinge, they were targeting early April. You've seen StubHub flip. You've seen Klarna flip. Circle went on the road this morning, which is an IPO we're incredibly excited about happening just next week. So I think you're starting to see that group of companies that was public market ready get out of the gates. So I'm optimistic. I'm optimistic that the second half of this year is going to be when you start to see these bigger names come to market.
Do we need clarity on the policies in Washington first? And how disruptive has that been for your business? I remember the president on the stock exchange floor alongside you.
Yeah.
This is not what we all expected. This has been chaotic for a lot of people. Do we need some clarity on those issues to see the calendar play out in the way that you expect?
So I think there's just been some uncertainty in the market. You can't argue that. If you're a good company, though, if you're a company that has made the plans to go public, which many have, they're public company ready, I think they can go in any market, particularly when you look at certain sectors. Crypto is certainly a sector where there's a lot of optimism still. Some companies are still trying to weigh the benefits or the issues associated with tariffs, and that's going to be a movable feast throughout the course of the year.
Everyone around this table is incredibly pro-America.
Yep.
You and I were on a panel together. You mentioned Davos, and we were talking about American exceptionalism. And then all of a sudden, people are talking about peak American exceptionalism and the rest of the world. Can we have a final word from you on that? The future of America and American exceptionalism?
There's nothing that beats our capital markets. There's no substitute for our capital markets. They're the deepest, most liquid in the world. They continue to be the envy of a world. The geopolitical situation, though, is a conversation. I think that's where I'll leave it.
That's a diplomatic way of putting it. Lynn, it's good to see you.
Good to see you,
Thanks for being here. Lynn Martin there, the president of the New York Stock Exchange.
I love it. That's a new one that a lot of companies can put into their portfolio of words to describe this environment. A conversation, macroeconomic uncertainty. We should collect them and just give them as sort of a panoply of
Removing
options.
guidance because of the conversation taking place between the US and the rest of the world.
Because there's a conversation that's going on right now.
Up next, Stephanie Roth of Wolfe Research, Amanda Lynam of BlackRock, looking ahead to a week full of economic data, Fed minutes and earnings from Nvidia. We'll get the outlook from them in just a moment. The opening bell 1 hour and 4 minutes away. Equity futures here near session highs, positive by 1.4%. Live from New York, you're watching Bloomberg TV. The opening bell is just around the corner, 60 minutes away. Equity futures on the S&P positive here by 1.3%. Following a 4-day slide, we're bouncing back here across the board with less than 1 hour until the cash open. Here are your morning movers with Danny Berger. Hey, Danny.
Hey, John. A lot to the upside this morning. Risk appetite is on. Tech seems to be leading it. AMD up 3%. A little bit of sell side action, too, frankly, over at HSBC. Upgrading the stock from a hold to reduce, saying that the deal with Saudi after Trump's trip to the Middle East does indeed put AMD in an attractive position. Also thinks that it can continue to outperform Intel. Now, I've been talking about this deal all this morning. Salesforce buying Informatica. It is finally official. Salesforce issuing a press release in the past hour saying that it would do this in an $8 billion deal. That means that Informatica priced at $25 a share. We are just below that this morning, up 5.6%. It's a deal that they had pursued at the end of last year. It fell apart, and that deal has been revived. Now, finally, John, you were talking about this earlier, but Southwest Airlines getting an upgrade from Jefferies, those shares up 2.5%. You mentioned the new business model, but we also now have some reporting from the Wall Street Journal over the weekend as to just how much your checked bag will cost when it begins this week. $35 for your first bag, $45 for your second, and unfortunately, John, I do think that includes your suit bags.
There you go. Chaos potentially there. Danny, thank you. It's the boarding process that's the most disruptive part of flying right now, like by far.
Basically, you have to bring your bag onto the plane or else you've got to pay $35.
So what's everyone going to do?
You're going to get on the plane first, which means people are pushing each other out of the way. Gate lice start getting involved. It becomes this real kind of crush.
Just explain what gate lice are, just so, you know, in case people don't quite understand that.
It was a term to people who are, say, in boarding zone 6. But when boarding zone 2 is called, they come up, and then when they scan their passes, it goes beep to try to shame them into not doing that.
There's certain flights I get on where everyone pretends they're Group 1.
Yeah, where?
Which tells me a lot about like the country that I'm going to as well. I love that.
Yeah.
Everyone's Group 1, I'm Group 1. But they're not Group 1.
Feel good about yourself.
You know,
Do they get
yes,
beeped?
Yes.
But do they get beeped?
No, they just walk straight onto the plane. I think some people sort of carry themselves as if they are Group 1 and they, you know, no one stops them.
Yeah, but then you end up with the crush.
Anyway, they need to fix that. We've got some economic data for you this morning and the week ahead. Let's get over to Bloomberg's Michael McKee with more. Good morning, Mike.
Good morning. Durable goods orders this morning. We're keeping track of what businesses are spending to see how they've been affected by the tariffs. And they have been affected, although the headline number down 6.3% is really a Boeing story, as it almost always is. Boeing orders down 51% during the month of April. The computers and electronic products, computers and related products, communications equipment, all this stuff that we get from Asia, down on the month. So capital goods orders, non-defense ex-air down 1.3% after rising by 0.3% the month before. So it looks like we are seeing something of a pullback in business spending as they get ready for tariffs. We get a lot more data the rest of today and tomorrow. Consumer confidence at 10 o'clock. This is the conference board version. We'll see if people are as unhappy in that as they are in the Michigan numbers. John Williams is speaking today at the Bank of Tokyo, at the Bank of Japan, rather, in Tokyo, and he's going to give us some idea of where he is. Fed minutes tomorrow. What were they saying at the last meeting about what they saw in terms of the tariff impacts? Jobless claims on Thursday. Might be a little early still, but according to a lot of Fed officials I've talked to, jobless claims are going to be one of the things they're following most closely. And then Friday, they are following PCE very closely. What's inflation doing there? So suggested it will slow down. But we also get income and spending and trade numbers. So Friday is a big day. And then, of course, we've got a big interview coming up at 9:30 this morning with Tom Barkin of the Richmond Fed.
Looking forward to that, Mike. We'll come back to you on that interview and some of the Fed speak in just a moment, so stay close. Michael McKee there on the economic data. So jobless claims on Thursday. The following Friday, payrolls. The May payrolls report is just around the corner. Stephanie Roth of Wolfe Research expecting the start of a downtrend, writing immigration will start draining labour supply, tightening the labour market. We might see an unusual environment with payrolls under 100K, but a steady or even lower unemployment rate. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
Let's build on that. Where's wage growth if those two things are taking place?
That means we have a slightly tighter labor market at the lower end. So the payroll gains could shift below 100,000, but that doesn't mean the economy's weakening. It's the foreign-born workers, which were driving the labor force in the past couple of years, driving employment gains in a big way, are going to be going the other way. So that just tells us that we have a much slower, steady state of growth of payrolls, but we might be tightening the labor market to some extent because we have potentially up to 100,000 people per month that are falling out of the labor force from this foreign-born population.
So if we get that negative supply shock, does it lead to higher prices, higher wages?
Wages haven't been a big driver of inflation, sure, modestly so. I wouldn't expect that to be the bigger driver. The bigger driver is, of course, going to be tariffs, which will probably show up over the summer. And I don't know if the market's expecting that at this point.
So what do you do with that? Is that a good thing if the unemployment rate drops, even if you don't have a lot of job creation, or is that a bad thing?
I think it's just a new reality that the market has to get accustomed to. So to the extent that we might have, some negative market reaction to a lower payrolls print or two, that may play out. But I think it's just a function of the Fed having trouble cutting this year, because we're going to see an environment where the unemployment rate is steady to potentially even slightly lower. In an environment where inflation is higher, that's not a recipe for cuts in the back half of this year.
Are you basically saying that we can just expect lower employment creation for the foreseeable future, and that can be okay? It might be less mobility when it comes to jobs, but it isn't the world falling off a cliff, and that isn't necessarily a harbinger of a real weakening in the economic data later this year.
I think that's exactly it. Is we should just get accustomed to payroll gains running at a slower pace, but that's not a scary thing. It could be an environment where claims are still steady, and it's just a sort of a new reality where immigration is going the other way. And it's just a slower trend of payrolls growth. And it's not necessarily a scary thing, although perhaps the market just has to get accustomed to it.
So what is the new 200K, the new 180? What's the number we should get accustomed to?
The new 95.
The new 95. Comfortable with 95. And unemployment with 95 might actually be lower, not higher.
That's correct.
Where does that leave the Fed?
That keeps the Fed on hold for a lot of this year. How are they going to cut in that
You've got
environment?
0 cuts for 25.
I think that's the direction of travel. It's hard to envision an environment where the unemployment rate is steady to slightly slower, job growth is at an okay pace, and we're not seeing claims rise. How's the Fed going to cut in that environment when inflation is running above 3%?
You think it stays above 3% for the remainder of the year?
I think there's a very good chance of that.
That's hot inflation. Can we call that hot inflation?
Yeah, I mean, we're not going to use the word transitory, but that's the concept, sure. But yes, it's high inflation. I'm just trying to get my head around where the Fed will be. You've got the New York Fed President John Williams speaking a little bit later in Tokyo, Japan. He said we might not be able to make a move until at least September. That's what he's indicated. But what I hear from Stephanie is that they're going to be on hold for quite a while, looking at 3% inflation and unemployment that's not climbing, that might actually be falling.
So I'm looking right now at the commentary that we got from Neil Kashkari over in Japan. And the reason why they're in Japan, by the way, because I did some research, is because the Bank of Japan is holding their Institute for Monetary and Economic Studies conference. So that's the reason why they're over there. I just wonder if there sort of is a split right now on the Fed with some numbers. I'm thinking of Chris Waller, who's talked about a sort of bias toward cutting rates, shifting toward that kind of reality. And others saying, hold on a second, we're expecting what Stephanie Roth expects.
I mean, I think Chris Waller may also be sort of playing for the job as Fed chair, so that might be an element of that. But I think the bulk of the Fed will be moving towards a reality of let's just wait and see. And then as their growth forecasts potentially shift up throughout the course of this year, then they're going to be shifting towards the environment of perhaps we're not going to be cutting.
Why do you reject what so many people who come on this show says is happening, which is consumers are weakening? They're becoming more discretionary. They aren't necessarily buying big ticket items. You're starting to see cracks or on the margins among a number of different consumer demographics. Why do you not see that as percolating into fundamentally weaker data?
This has been the story for the past 2.5 years, and the economy's been okay. So it's been partially sure. There's been cracks at the lower end, but the bulk of the economy has been doing just fine from a consumer perspective. We've had healthy gains in equities, healthy gains in housing. That's not really gone away in a material way. Now, equity markets have done a bit of a round trip this year. The consumer is doing okay as long as they're employed. So I'm not worried about these significant cracks at the lower end really getting much bigger. Now it's just a backdrop of, the consumer spending in line with their income growth. And by the way, on the travel side, as we were talking about earlier, perhaps some of the issues that we've had with flight safety has actually been weighing on travel sentiment for the past couple of months. And I think that might be one thing that was weighing on prices of travel. And we might see that reverse over the summer.
When Delta first came out and talked about the weakness in the middle of February, they did point to the aviation safety issues, not just the policies coming out of Washington, but some of those issues as well.
Sure, that's definitely a part. At the same time, you have seen international travel fall, and you do see ongoing questions around domestic travel at a time when certainly in the main cabin, I'm talking not the premium seats and the people who actually are in group 1 and 2.
And not pretending.
Or maybe they are pretending because they're in the back of the cabin. I mean, you've seen those people really push back. So there are a lot of questions here about just how much hesitance there actually is.
The estimate for next Friday, by the way, is 130. That's down from 177. So using the Stephanie Roth adjustment, what's that? 210?
Yeah, that's a fantastic
like
number.
that.
Basically, we're all off to the races. Is that 220? would you say?
210, 220.
That sounds, yeah, but that sounds,
like that. All right.
That would be high.
All right, Stephanie, thank you. It's good to see you. Stephanie Roth there of Wolfe Research on the economic data. A lot to look forward to. Mike McKee, including Mike McKee, the Federal Reserve speak we're going to get a little bit later. What are you looking for, and what have you heard so far?
Well, basically what we're hearing, John, is the same thing that everybody is telling you on set, that nobody knows what the Fed is going to do or when they're going to do it, because nobody knows what the impact of the tariffs are. There is one interesting aspect to this all that just makes it even more confusing. You take a look at what's happened with equities and with bonds. And you had Lynn Martin on a little while ago talking about the volume and volatility she's seen. This is the S&P 500. That's the definition of some volatility, when Trump says one thing and then changes his mind a couple days later. But there's one asset class that has not moved. It's the dollar. The dollar just keeps going down through all of this. And that is not particularly good news for the Fed, because when you impose tariffs, it means people buy less foreign goods, less demand for dollars. And at this point, the dollar should be going up, but it's not. And that's a confusing situation for the Fed. As long as the dollar keeps going down, it means that U.S. imports are going to be more expensive. And that's not, that's what the president wants to see, but that's not what the economy overall needs. There's not a lot of good explanations for this. But the one thing that people have been telling me as I've been traveling around the country these past few weeks is it may be just a sell the USA at this point. Not a lot of confidence in the United States. You can't get completely out of the dollar because it's too important. But there is concern about what's going on.
Mike McKee, thank you, sir. Concern for a lot of investors as well. Equities down, bond yields up. That's been a problem. Bond yields up, dollar weaker. That's been a problem too.
This sort of toxic brew of correlations breaking down has been something that people need to watch. There is this question with the dollar about whether it was just overvalued, though, coming into the year, and whether some of the correction that we've seen has really just been a virtue of that rather than truly sell America.
The DXY at 99 is not weak at all, to your point.
That's one of the theories out there, but it is so difficult. It is narrative roulette. We talk about that every morning. It's the conversation, as Lynn Martin said.
But FX is always relative, and relative to the start of the year, we're a whole lot weaker. 99.28 on DXY. Amanda Lynam of BlackRock joins us around the table. Amanda, good to see you.
Good morning. Thank you for having me.
You've been focusing on the interplay between margins and the labour market. Let's get an update. Where are we now?
Yeah, I think Anil Kashkari said it well to your colleagues over in Asia. Their time is of the essence here. Companies are in a bit of a wait and see mode. This is something that's been coming up in our client conversations over the past few weeks, including some conferences. Corporates are signaling that they're in a wait and see mode, but there's an expiration date on that wait and see, and I think that's really what we're focusing on. This really just hinges on the labor market. You heard Stephanie say consumers can spend so long as their employment situation is solid. It's really that interplay between margins and the layoff rate that I think is going to determine the path from here.
So when's the expiration date?
Well, I think the Fed is almost laying the groundwork for focusing the market on September and even going forward from that. I think if we can get through the next earnings season, this earnings season, I think positively surprised. If we can get through the next earnings season, I think that will provide some clarity. But I kind of take a step back. If I'm a corporate CFO, and I thought your conversation with Lynn Martin was great, at some point they just have to move on with it and and go through kind of the strategic initiatives that they need to enact. So, for example, we've actually seen strategic M&A rebound a bit. It wasn't that depressed to begin with, but I think corporates that are looking to do transactions to bolster their business are actually moving ahead with it. Where we've seen some lagging is on the private equity sponsor-related M&A, where financial, economics are a bigger part of the equation. But I think to a certain extent, there's almost a level of optimism that no matter the path, corporates can manage through it. And to a certain extent, we're actually, I think, starting to see a bit more of that.
So if you talk to corporate executives, you get a sense of optimism. You get a sense that they're going to keep on going, that there's certain levels of demand that are just going to be sticky and that they can plan their business around that. Where the cracks are going to come is the consumer. That's what everyone has been saying. How much do you really believe in that, given that you see real contradictory types of data on that?
Yeah, and I think it's a great point. Sometimes folks describe it as mixed signals to us, but what I actually think is happening is that just like there's been dispersion in corporate credit, liquid, private, commercial real estate, there's also dispersion in the consumer. One of the things that's jumping out in the recent data is that those consumers with student loans, now that those are actually impacting their credit scores and the delinquencies, are coming under more pressure. So there's a bifurcation that has always existed adjusted amongst consumer income cohorts. But we believe in this cycle it matters more because the rate environment is really a forcing factor for affordability. So if you have floating rate exposures, you have high mortgage rates, these, I would say, differences in consumer strength are becoming more prominent in this cycle versus previous cycles. I think what we really need to focus on is, does that weakness that is so far confined to the low-end consumer extend more broadly up into the higher income consumer? We're not seeing it yet, but that doesn't mean that that risk isn't out there. So we're finally attuned to kind of what does that labor market dynamic look like?
And if we see that migration, that certainly poses a threat to the headline data, that's for sure. I wanted to talk to you about the price of credit at the moment. We've had a lot of guests come on and talk about the riskiness of government debt and hardly any talk about the riskiness of corporate credit. How are the two trading relative to each other at the moment?
Right. So I would say, let's use high yield as an example because
Sure.
it's a bit more growth sensitive. The tights for high yield spreads were 256 earlier in the summer. We're at 330. So we're not back to that kind of euphoric period of mid-February, but we're certainly well below the post-financial crisis average. So I think where there is for sure some room for spreads to widen. I think going back to your point, Lisa, though, there's almost a sense of front-footed behavior amongst investors as well, that they're cognizant of the fact that they cannot time these developments. I think what happened over the weekend is a great example. We left Friday. It seemed like a bit of a risk-off tone. We come in this morning. It's very risk-on. Corporates, just like investors, don't want to be on the sidelines. And so there's almost a kind of just move forward and kind of invest with the assumption that there will be some volatility from here.
Bank of America pointed out that some Microsoft credits, some maturities are trading through the treasuries. And I want to understand from your perspective whether you are seeing some investors begin to treat certain corporate credits as more safe than maybe the US Treasury, which sounds bizarre saying it out loud. Are you seeing that take place?
So I would say that part of the market. So when I started in corporate credit in 2005, there were actually a fair amount of AAA corporates left. There are really only 2 AAA corporates and then a handful of universities. That whole segment of the market is about $90 billion US dollars, AAA rated corporates. It's very technical. It trades very tight. It also depends upon where are you on the curve, where your spread is getting calculated. So I wouldn't take that as an arbiter of this is a better credit than the US. I think what it is just the fact that over time, over the past 15 years, there's been a migration down in credit quality in the U.S. A lot of corporates are just happy to be BBB. They don't need to be AA or AAA anymore like they were in 2005. And I think that's really what you're seeing.
Is there a lesson also, though, about who the buyers are at any given time of the Treasury market versus the corporate debt market, that they're two distinct buyer bases with different metrics to understand when to come in and when not to?
Absolutely. I do think that there's a healthy amount of market segmentation that has been in place and remains in place between those two market cohorts. I really just think, though, if I'm an investor looking to deploy money in the corporate credit market, I see more scope for balance sheet deterioration amongst AAA and AA rated corporates in this environment than I do in BBBs. And you know our view. We like selectively moving down in credit quality. So for choice, I would prefer to be in the low end of investment grade, where I'm pretty sure those companies will want to stay investment grade.
To your point, though, is that by design, that deterioration? Is that because someone in the C-suite has said, we should do this?
And I think that actually the historical experience shows that your cost of capital as a AA rated corporate isn't that much less expensive or isn't that much cheaper than a BBB rated corporate. And so I think over time there's been a steady migration. Now, I think corporates use that prudently. They're not going to lever up just to do a run-of-the-mill buyback. They'll wait for the right acquisition. They'll wait for the right time to add that debt to the capital structure. But that's been a long-term trend that's been in place for the past 10, 15 years. And I think actually those BBB corporates are just fine. And even some of those high end of high yield corporates are just fine as well.
Amanda Lynam of BlackRock, thank you. Good to see you. One way to put it might be, if you are AAA still, you lack imagination. Is that the way to put it?
Is that the way that we're spinning what happened with the United States?
Based on that conversation.
Credit rating? Look, debt is not a bad thing. If used correctly and prudently, it can be a positive
Precisely.
thing. And there's certain tax benefits that companies get from issuing debt also that makes it a lot cheaper than what it looks like on the headline level. If you have big, grand ideas, this is the country where you can borrow to engage in them.
That's the spirit.
Go for it.
Nice.
Don't be AAA and dowdy.
Amanda, this was good. Always a clinic. Thank you. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. Shares of Informatica are rising in the pre-market after Salesforce announced it was buying the company for $8 billion. Salesforce CEO Mark Benioff saying the deal will create the most complete agent-ready data platform in the industry. This will be one of Salesforce's biggest acquisitions ever, and it expects it to close early in its fiscal year 2027. Meanwhile, German Chancellor Friedrich Merz says Ukraine has been given permission to use weapons given by its allies to strike deep inside Russia. Ukrainian President Volodymyr Zelensky has long appealed for this authorization. And President Trump wants to cancel all federal funds directed to Harvard. The New York Times reporting the president will send a letter to agencies instructing them to end contracts totaling about $100 million with the university. The letter cites a pattern in which Harvard has shown a, quote, lack of commitment to non-discrimination and our national values and priorities. The saga continues. That's your Bloomberg Brief. John?
Indeed it does. Yahara, thank you. Thanks for this morning. Up next on the program, we'll set you up for the week ahead, live from New York City. You're watching Bloomberg TV. Equities positive by 1.2% on the S&P. The open about 36 minutes away. As we count you down, the trading diary looks like this. At 8 p.m. Eastern Time, New York Fed President John Williams speaks in Tokyo. On Wednesday, Fed Minutes Plus, Nvidia earnings after the closing bell. Thursday, another round of jobless claims. And on Friday, a read on inflation, PCE, and UMich consumer sentiment. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, the fate of this market day today seems to be in the hands of one man. What's the schedule for that one man today?
Yeah, hey, John. Well, actually, President Trump doesn't have much on his public schedule today after what was the long Memorial Day weekend, but we are starting to look out for clues on whether or not there could be any sort of momentum when it comes to trade deals. We had NEC Director Kevin Hassett say in an interview earlier this morning, some could come this week. Of course, this echoes messaging that we've heard from the administration last week as well. But interestingly, John, he did say that we could see tariffs drop below 10% for some countries if they do come to the table with good enough deals. Of course, it had been our understanding that 10% really was that floor. Now, of course, it's one of the countries, the trading partners that we're watching closely here is the European Union, which we're not expecting to be resolved this week or get a tariff below 10%. And the stakes are high. John, Bloomberg Economics says that if that 50% tariff goes into place against the EU, ultimately it would cut EU exports to the U.S. by more than half.
Tyler Kendall with the latest in Washington. Can you imagine if someone gets below 10%, how the British might feel? The UK?
Jilted. A spot angry.
Oh, is that your accent?
I mean, I think I offended a lot of people.
Probably a good place to leave this programme. All right. Look at that clock.
What did you think of that? You didn't like that?
That was like, you know, what was that Mary Poppins stuff? That was like Mary Poppins. Was that Dick Van Dyke?
That was my jump play.
All right. Come up tomorrow. I'm moving on. David Leibovitz of JP Morgan Asset Management, Monica Guerri of Morgan Stanley, Gon Grossman, French Hill of Arkansas, and Aaron Cannon of Clear Harbor Asset Management, live from New York. I don't know what that was. This was Bloomberg Surveillance.